Hey, it's Chris with Life 180, and for this video, I'm actually going to be sharing a complete replay of a summit that I was a presenter at. I was kind of blessed to be one of 8 presenters on this wonderful summit with a lot of people that attended live. It was an event that was put on last week, and the person who threw this event, Sarah Sullivan, actually gave us a link to share and gave me permission to share this on my YouTube channel to be able to serve my audience and give you all this great information. Now, I was one of 8 presenters. I believe it was about 8, maybe it was 7 or 9, it was give or take. But the bottom line is there were many presenters talking about how to create passive income and how to invest in different areas. And a lot of entrepreneurs on the event. There was how to invest in multi-unit properties from a passive income perspective, how to invest in pre-IPO startups, which is a fascinating topic to me. High risk, super high reward. Somebody talked about if you invested $50 in Uber when it was in the pre-IPO stage, if you invested at the right time, it would have been worth like over $1 million for $50. Those kinds of examples, like I said, high risk because you're getting involved really early, but it's an opportunity. There's a company called Udirect, which Kaaren Hall, I'm looking forward to getting her on this channel and actually interviewing her, talking about self-directed IRAs and what they call solo 401ks. Now, that's an amazing opportunity. Anybody who watches this channel knows I'm not really big on 401ks. Actually, I'm kind of against them. But when you look at what they're able to do, to utilize the IRA and 401k chassis to be able to get it self-directed so you can invest in things you know, so you can put it, I'm gonna let you watch her talk about it because it's fascinating. There was a lot of questions as she went through. She talks a lot in the Q&A at the end. This is a long video, it's 4.5 hours almost, but I promise you, if you watch this, this was a summit that a lot of people attended. The value is there. I encourage you to kind of bounce around. I'm going to try to create chapters in here. So if you look below, we'll have different chapters on who is the presenter in different stages, and I'll try to break it down. So look in the description below if you want to find those chapters. You can also, all the links that you need in descriptions will be down in the description down below here. If you haven't already, feel free, please subscribe and click that bell on this channel because I'm creating all sorts of content like this, serving with the goal of serving entrepreneurs at the biggest level we possibly can. If you have any questions, comment in the comments below. If there's any content or topics that you want me to be making a video about, also feel free to comment in the link below, or in the comment section below. If you look at all my videos, I make a real effort to engage with almost every comment, as many comments as possible. If there's one I haven't engaged with, it's because it slipped through the cracks. So anyway, I hope you enjoy this presentation. I know there's a lot of really amazing content and information on here to serve you. Take the time, go through it all. I know you're gonna find value. Go out and crush it. I'll see you on the next video.
All right. So for those of you just joining us, welcome to Build Your Legacy. So this will be a virtual summit for the next few hours. I am so happy you're here. We have a great lineup for you. So we have 6 speakers who are going to talk to you about their expertise. I'm going to run through the logistics first, and then I will get into the meat of what we're going to talk about. Okay, so like I said, we have 6 speakers. It's a great lineup for you. They will be talking on how to invest. They'll be talking on mindset. They'll be talking on tax. They'll be talking about whole life insurance, real estate investing, what's going on in the markets with this crazy time with COVID. We're going to cover all of that. How to set up your life, how to set up systems in your life so that you you're not just thinking about money coming in the door, but what your money does for you after it's in your bank account so that you can create a legacy for yourself, for your family, all those great things. So we have planned content for the next 4.5 hours. And then at the end, we're going to have a Q&A. So feel free in the chat while we're talking to the speakers, put your questions in the chat. And if we're able to, we will address it at that time. If we're not able to address your question at that time, we're going to have a Q&A at the end. So all the speakers are going to come back on and we will just open it up. We'll have no presentations at that time. We'll just be looking at the chat. We'll be looking what you're asking. We will be answering your questions, and we can stay on as long as you want. So again, feel free to type your questions during the chat, and then if we can answer them during when the speakers are on individually, we will do that. Otherwise, we will get to it at the end. Okay, so those are the logistics. I hope you guys have cleared your calendars. You don't have distractions. It's going to be some great content. All right. So for those of you who just joined, I would love to see, yes, I see a question, will this be recorded? This is being recorded right now. But yeah, so hi, Tim. Good to see you, Tim. Please go ahead and write in the chat where you are joining us from. I love to know where people are joining from. It helps me get an idea of the markets people are in. And if I know your name, it's great to see that you're joining us live here. Hi, Leah. Yes, hello. Good to see you. Hi, Kathy. Kathy from Phoenix. Great to see you. Great. Granada Hills. Hey, Mark. Good to see you on here. Okay. So first, I'm going to start talking about, you guys are all in the right place. This series of speakers is for people who, we kind of have two target markets. So people who are around my age, who are kind of mid-career, who have been really, pumping hard to earn money and really advance their careers, whether you're an entrepreneur, whether you're in corporate, and you've been really thinking hard about how to earn more money. But maybe you haven't quite started thinking about what to do with that money once it's come into your life. Maybe you have it in a 401k with your corporate company and it's earning 5%. We're going to let you know that there's some really amazing options for you in that area. Maybe it's just kind of daunting for you. You haven't really thought about, the long-term strategy plan for your money. Well, we have tax planners, we have wealth management advisors. We're going to talk to you about off Wall Street options for you. This is also for people who are maybe at the end of their career and they have saved up quite a bit of money and they are looking to retire. And I noticed that a lot of people who are nearing the end of their career and they're looking to retire, they've saved up a lot of money, but the world has changed, right? The world has changed drastically in the last 20 years. So maybe what they thought was enough to save up to support their lifestyle, maybe prices have changed, interest rates have changed, a lot of things have changed, and now their original plan won't support their life the way that they want to live it. So this is also for you if you're in that category. So I see people thinking about shrinking their expenses when they quit working. And although I think that is, an option for some people, there's also a way to live life where you can expand. You can continue living your same lifestyle as long as you pay attention to your taxes, you pay attention to your investments, and you don't follow kind of the mainstream that's out there, which says reduce and just watch your portfolio grow at 5%, because that's not going to get you any luxury anywhere fast. Okay, so that's who this event is for. I would love to hear, I think actually I'm recognizing a lot of the names, so I know kind of what buckets you guys might fall into, but I'd love to see which bucket you might consider yourself falling into. Are you mid-career and you're starting to learn about planning for later in your life? Are you looking for more cash flow today, so some more passive cash flow today? Or are you nearing the end of your career and you're looking for ways to live more luxuriously in your retirement? Please type in the chat and let me know. Love to kind of know where everyone's coming from. Okay, so now I'm going to jump into my presentation. It's going to be mid-career rebuilding cash flow. Yes, we're going to talk about cash flow for sure, passive income for sure. All right. So I'm going to share my screen, going to share a quick presentation, just so you guys get to know me, those who are not familiar with me, and then we will jump into the other speakers. Okay, so hello, I am Sarah Sullivan. I'm the founder and CEO of Sugo Capital, and we connect investors to strong passive income opportunities. And I will explain what I mean by that. I want to let you all know that there is going to be a big give at the end. So most of the speakers have a free gift for you. And so stay until the end. We'll put links in the chat with all those free gifts. And then I'll have a free gift for you as well. So that'll be a reward for staying on through opening your minds, absorbing all the great information that we're going to be sharing. And yes. Okay, so a little about me. How this came to be. How did I get to be where I am? Okay, so I started out thinking that, education is extremely important. So I went to university, UC San Diego, did the traditional, studied business, went to working, and I thought, oh, things are kind of tight. I want to earn some more money. I want to live a more luxurious life. So what did I do? I went back and got another degree. I went to one of the top 10% full-time MBAs in the country, UC Davis, got an MBA, went back to corporate, advanced in my career in tech in Silicon Valley. And I was making more money than I thought I would ever make, when I was in college. And I thought, wow, I'm making so much money, but I still feel like I don't have room to breathe. I still think about at night, what am I going to do when I stop working? I have a lot of money coming in, but what am I doing with that so that one day I can stop trading my time for money? And so I started at that point, this was about 7, 8 years ago now, I started studying what the uber wealthy do. And no surprise, real estate makes the most millionaires in this country. So I said, okay, let me learn about real estate and find what interests me. So I took courses with RE Mentor. You can look them up. They're amazing. I took courses at Rich Dad University. They're amazing. I learned about over 15 different types of real estate investing. And so you might know, okay, I can invest, I can get a single family home and rent it, get some passive income that way. That is one way. There are many, many ways to make a lot of money in real estate, and investing in general. And so what I want to encourage all of you to do is to open your minds and learn more about investing in general and find what really interests you. Because what I found that really interested me was real estate. And so I spent, I don't even know how many hours learning and learning and learning about how to invest in real estate, how to choose partners, how to choose markets, how to choose properties. And, I'd wake up on Saturday morning, get on my phone and study markets, studying, what's the job growth rate in Columbia, North Carolina. Like, that's what I love doing. And so I encourage you to find what type of investing you love, and then you will learn enough in that area in order to expand and make a lot of money in that area. Okay, so on my journey, it wasn't all amazing. So I started out investing in single family homes, and this is the picture on the left is my first rental that I bought, and it was so cute and it fit all the rules that I had learned, and it was going to be amazing. But we had an awful property management company. You can see the picture on the right is when we sold it. We lost a ton of money on it. But I knew that people were making millions, millionaires were making millions in real estate. I knew there was still a place for me in real estate. So I kept going. I found something else. So long story short, now what I invest in is hotel development and apartments. So large apartment complexes, 100 plus units. And now my returns are 18 to 25% passive returns. And so of course, those are not guaranteed. It's an investment. No investments are guaranteed. But this is what I invest in, and that's the shift I made. And so then, I started telling people about, hey, look at these returns that I'm receiving. And people asked, how can I do the same? And that's what started this journey of me starting to create content, starting this big awareness campaign, bringing together the ecosystems that you're going to find today, you know, people in tax, people in retirement accounts, people in this ecosystem who can help you build your legacy, build your portfolio in ways that you might not know about that are, you know, off Wall Street. So we have some examples. I'm in the interest of time, I'm going to speed through this, but these are some people that invested in apartments that I suggested to them, that I connected them to. You can see some of their returns, totally passive. So they're not even in the state where their apartment building is, they're a partial owner. And I'm going to get into and explain to you how this works. This is Emil, he's in Colorado, his property is in North Carolina. These are the returns he's getting. He's not doing anything. He wrote a check, he sits back, he receives the checks. And so, like I said, you know, after people started asking me and I was connecting them to these types of returns, I said to myself, imagine what kind of impact I could have on people's lives if I wasn't limited to sharing this with people I saw in person. You know, just my one-on-one contact, that really was limiting to how I could share this good news. And so that's when I started the Confident Investor, Women's Wealth, Build Your Legacy, all these events where we bring the ecosystem together and we holistically help people learn how to invest in and build a legacy for themselves. Okay, so we are going to, over the next few hours, be talking a lot about investing and taxes and numbers. And so, you know, this is the legalese. I'm going to get through real quick, but I'm going to read it word for word because it's very important. So, numbers and opinions I'm about to display are what I've seen in the market and via the educational classes and workshops I've taken, same with the other speakers. So you should do your own research and education before deciding which asset class is right for your investment goals and portfolio risk tolerance. This communication is for educational purposes only and should not be regarded as a recommendation, an offer to sell securities, or a solicitation of an offer to buy any investment products, financial products, or services. So basically, we're not selling you anything in this webinar. On this summit, we are just sharing our knowledge and expertise. No part of this presentation or attachment is intended to be binding on Sarah Sullivan or Sugo Capital or supersede any issue or offer materials. There are risks associated with investing, all types, obviously, including principal loss. Okay, boring stuff over. So this is a quote from Kevin Hart. So I went to a real estate investing summit and Kevin Hart was one of the speakers. And I don't know if you know, but he owns like 20 different apartment buildings. As soon as he gets the check in, he puts it towards an apartment building. He racks up the apartment buildings. And he said this quote, which I love: "The game of Monopoly is a real game." Okay. So what I'm going to talk about, and I'll just spend about the next 10 minutes on it, is multifamily syndication. So this is my area of expertise, and this is how I help people build their legacy. It's through apartment buildings. It's through passive investing in apartment buildings. And who can invest in these? Are anyone. Anyone can invest in an apartment building passively. And I'm going to talk to you about how you can do that. And how does this fit into build your legacy? How does this build legacy? Well, I'm going to show you some model returns. And again, they're just model returns. It's not an actual apartment building, but I'll show you the structure and how it works. And you might be surprised at the numbers. These are averages. These are model numbers. So whether you are looking to invest with me, invest with someone else, if you like the model, go out there and find it, because these are some great ways to build your wealth in hard assets that don't fluctuate. So we all have seen what's been going on with the stock market, some great things and some tough things. And so real estate, especially in the commercial and multifamily space, does not fluctuate like that. And so I invest in it personally because I find it to be really predictable and you can count on it. So My goal in this is to share the model with you as something that is a predictable investment. And, ongoing, I do a lot of education around how to choose a passive investment. So this will just be a really light introduction to how it works. Okay. So say, for example, that we're purchasing an apartment building for $1 million. So there are some costs to that. Some is down payment, some is loan, some is closing cost. And so as a management team, me and my partners, we don't put all the money into it ourselves. So we look for capital for the project from passive investors who could be people like yourselves in the audience. And so here's the pie chart of all the money that's needed to purchase an apartment building. So we break it down. We have GP, the general partners. They supply some money. Then there's LPs, they're limited partners. And that would be folks like yourself who can invest, but stay totally passive. Limited partner means you're not responsible for the loan. You're not responsible should there be any, a tenant sues because they fell down the stairs and broke their leg, there'd be no liability for the LP partners. So it's a very protected way to own real estate. And so this is how we source the money in order to purchase apartment buildings. And then there's the ownership side, and you can see that it's quite lopsided, but in your favor. So the ownership. So we take the apartment building and we put it in an LLC. And so for basically, you're buying shares of that LLC. And how do we distribute ownership? So for 30% of the capital, we don't give investors 30% ownership. We give them 70% ownership. And that is amazing for you because then as we do a forced appreciation program, you're not just earning interest on ownership equal to the amount of the capital that you're putting in, it's more than double. And so that's how the returns are so big when you invest in multifamily syndication. Okay, so I'm going to show you basically if you're out there and you hear, okay, this looks interesting, I'm going to do some research on looking for syndicators out there. When you look at a project, here's some things that you might see. You're going to see targeted cash on cash return. I just want to let you guys know what these mean so that as you start getting out there, you can react to them. So cash on cash return, that means that you might get a monthly check, you might get a quarterly check. And so say the property is being held for 5 years, as this one says targeted investment period, 5 years, you will be getting 8% cash on cash return on your investment for each quarter or each month it's paid out for that duration. Then there's something called the targeted investor annualized return. And that means if you take into account the appreciation and the cash flow as a percent of the rents that you have, what would be your total return? And so often you'll see around 20%. So it's very common to see between 15 and 22%. Right now, what we're seeing is closer to 20%. And then investment profile. So some are going to be a new build. Like for instance, when I invest in hotels, I invest in new build projects. If you see something called a value add, it means it's an existing structure and they're going to do some remodel, repositioning, value add. Targeted investment period, very important to pay attention to if you're considering investing. What this means is this is the time that the property will be owned. All the investors, so there might be 50 investors together on a project. And everyone will go into the purchase together and everyone will exit the purchase together, which means that your principal invested is not liquid during this time. And so some people say, oh, I want to invest for 2 years and then take the money out to send my kid to college. You're not able to do that in this type of investment. So make sure you look at the target investment period for the project in order to know if it's going to be good for you. So it's really great for legacy building because oftentimes it can be 5, 7, 10 years that the management team is expecting to hold the project. And so that's why it can be a great legacy building longer term strategy for folks. Okay, so using the example on the previous page, I just want to show you how the finances would be how the returns would be paid out to see if it's something that you're interested in. Okay, so if you have a $100,000 investment on a 5-year project, you'd get $8,000 per year. It may be paid out monthly, maybe paid out quarterly. And then when the project is sold, you can see proceeds from sale in orange, $60,000. Now, how is that so high? It's because for 30% of the purchase price, you get 70% ownership. So you get appreciation on a very large chunk of the project. And so also, obviously, when the project is sold, when the property is sold, then you get your original principal returned. And so looking at the math, basically at the end, you've gotten your investment back, you've gotten your returns. In this model, you have $200,000. So it's a double your money in 5 years project in this example. So this is not an actual opportunity I'm showing you, but just this is how you would read it. And so a lot of times you'll also see is it when someone's presenting it, they'll say it's a 2x multiple, which means you'll double your money in the hold period that they're talking about. So now I'm going to chat about what's important when someone shows you one of these. What's your first step that you need to do? The first step is you want to take a look at the team that's approaching you with this opportunity. And so a lot of people look at the returns first and the property first, but that's backwards. You want to look at the team first, make sure they have enough years experience, make sure that they've already exited some properties because that's going to be where you get the most return. You can do background checks on people without them even knowing. So you want to do that on the sponsors. You want to do that for the property management team that's going to be managing the property, the extended team. It's very important. And then second, you want to look at the market. So you can have a great property, but it's in an awful market and you wouldn't want to invest in that. So we have someone coming on later who's going to really talk to us about markets and where they're seeing some strong markets right now. Because the market, the real estate market is not really a market. So it's divided into residential, commercial, multifamily, industrial. Each one performs differently in any economic situation, and each state, each county, each city performs differently. So you might have a place like Columbia, South Carolina, that's an amazing place to invest right now. And then you might have somewhere in another state that is an awful place to invest right now. So when people talk about the real estate market, you have to talk about it on a city or county basis. And then finally, you would look at the property, look at the business plan that's being proposed to you. So then if that looks exciting to you, I want to talk about the ways that you can invest. So you don't need cash in your savings account in order to invest in these types of properties. Of course, you can invest with cash. We have someone talking later who's going to talk about the tax implications of investing in all these different ways. You can invest with a self-directed IRA. We also have someone who's going to talk to you about how you would do that. So pretty much any retirement account that you have, take a look at it. How is it performing? Seriously, if you're getting 3 to 5%, you can roll that into, you probably don't want to stay there if you're getting 3 to 5%. But you can roll that money into an account called a self-directed IRA. And you can use that to invest in alternative assets. So you can invest in a single family home rental. You can invest in an apartment syndication. You can invest in a startup. We have someone who's going to come on talking about how to invest in startups, crowdfunding for startups. Sometimes you can use this account to do that. You can use it to invest in Bitcoin and gold and all these different things. So there are a lot of alternative assets open to you if you roll your retirement accounts into a self-directed IRA in order to invest. You can also use something called a solo 401k. So I know a lot of you here were invited by Chris Kirkpatrick. So welcome to you guys. So I know there's quite a few entrepreneurs in the audience. So if you're an entrepreneur, you can open something called a solo 401k. You can use that to invest in real estate and alternative assets. You can use an LLC to invest in real estate. You can use a family trust. We have people do this all the time. All these entities, pretty much any entity that has an EIN number you can use to invest in real estate. So instead of being in your name, it's in the name of the entity. And then also cash value life insurance. A lot of people take out loans against their cash value life insurance in order to invest, whether it's in real estate or something else. We have someone who's going to talk to you a little bit more about that as well, to see how that can really explode your future financial situation. Okay, so like I said, I began my research 7-8 years ago about what do the wealthy do. And one of the big things that opened my eyes to the type of investing that I do now is I saw that 80% of family office funds are invested in real estate. So if you don't know what a family office is, this is for the uber wealthy. So people who are really high net worth families, they'll have a family office who make sure that their funds and their assets and everything is taken care of. And so 80% of family office funds, 80% of funds of the uber wealthy are invested in real estate. And the majority are in syndications, whether it's multifamily or commercial syndications. And so that's when I went, okay, well, if this is what the uber wealthy are doing, that's the direction I want to go. I'm going to follow what they're doing. And you know, there's so many people with a lot of money who invest in real estate, pro athletes, politicians, celebrities, all of them. Of course, it's open to everyone though. And just want to encourage you guys to realize that when you invest in physical assets, if you choose the markets correctly, and if you choose the team correctly, they don't disappear overnight. So we all have been seeing what's going on with the stock market. So the real estate market does not fluctuate like that. This morning I was looking at my Zoom stock and I was like, this is amazing. Why didn't I put several $100,000 into Zoom stock? But it's because it's speculative. You don't know what it's going to do. And so instead I put several $100,000 into a multifamily syndication because I know what that's going to do. So I encourage you to take a look at assets that don't fluctuate if you're investing for your future. Okay, well, that is the end of my presentation, the end of my spiel. And so I'm going to just pop over and check in. Is there anyone who has any questions for me in the chat? If you have any questions about this, please pop over to the chat and put in some questions. I'll answer them. And then if not, we're going to invite our first speaker on. Okay, don't see any questions. So I'm going to go back and invite Chris. I see you're here. Why don't you go ahead and jump on in?
Does that work?
That works.
All
Great.
right.
Great
Hey,
to see you. So glad that you're here.
me too. This will be fun.
Yeah. So I've introduced the concept of real estate to people, and that's what we've gotten to so far. So I did say that we're going to have someone on who's going to talk about, you know, shifting your mindset about what does your money do, not just thinking about money that comes in your door, but think holistically about what you do with your money after that. And so everyone, this is Chris Kirkpatrick, and that's what he's going to be talking to us about. So he is very creative and very holistic in the way that he thinks about building your business and building your financial life. So Chris, welcome.
Awesome. It's great to be here. Yeah. So it's a really passionate topic for me. I spent a lot of time in the financial industry. I was classic licensed, being able to sell equities and, you know, just kind of the classic financial route. And for me, I just quickly realized within a couple of years that ship is kind of broken. And, you know, if you look at the traditional methods that people follow in the United States specifically, it's a busted model. I mean, we've never had worse results. And you know, so I started looking at like what are alternative ways that we can do for our family? What are our alternative ways that we can you know, really look at just not investing for accumulation like most people think about, but investing for cash flow, investing for like ways that you can control in yourself. I mean, we all hear these cliches that your best investment is in yourself, and that sounds like a cliche, but I think a lot of people just don't know what to do with that, right? So when you hear something like that, you're like, it sounds good, but what the heck do I do with it, right? And so what I've found, and I don't mean this to like be negative, but what I've found is like most people just kind of lack creativity and lack vision. And so what I love doing is being able to show people that yes, your best investment is in fact in yourself. And yes, like my passion and the statement of our and kind of like the byline of our of my company at life180.com is we help entrepreneurs create the life that they love. And it's not just stuck on entrepreneurs. I mean, I help a lot of people, but our focus is entrepreneurs. And it's all about creating the life that you love, because it's if you get creative and if you put your money in a self-directed IRA, if you do cash value life insurance, and if you think about how to create cash flow differently than the system is teaching us and that our parents probably did, and all those things, you can actually have your cake and eat it too, right? So it's kind of cool.
Yeah, I love that. And when Chris and I started getting to know each other, I found that we were very aligned on, something I said at the beginning, um, that in order to become financially free, you should not think about shrinking your life. You shouldn't think about how much can I reduce my expenses, but more, how much can I expand my investments? How much can I expand my cash flow in order to support the lifestyle? So I love that that's specifically what you're doing for your clients, Chris. It's lifestyle investing, and also, like you said, a lot of us start our own businesses because
Mhm.
we want a different life.
That's the truth. Yeah.
And
Yeah, no, it's one of those things for me. I always kind of I talk to a lot of people, and some people are really well off and far down the road, and then I talk to them and they're like, "Wow, I wish I knew this 20 years ago," right? And some people are just kind of in this middle stage, and some people are just getting started, and they feel hopeless. There's a lot of people in their 45 to 55-year-old range, and they're kind of feeling behind the eight ball, because I think most people are. And they kind of, when you hit that point and you start looking at financial calculators and whatnot, like it's really easy to feel overwhelmed. It's really easy to feel like, holy cow, this is never going to work. And the reality is it can work really easily. Like it's very, very doable. It's not going to work if you do it the way that the system's trying to tell you what to do. And, but what I find with that is that most people's need is not to get a better return. And yes, the better return, all that's like obviously essential than the traditional kind of methodologies. But their biggest need is more cash flow. Their biggest need is creating more income, more revenue. And that's where I love like helping people build their businesses. That's where I love helping people figure out different alternative strategies. And so let me just kind of use an example. Like a lot of people give me a hard time. I'm a crazy person. Like everything I do, I'm always looking for an angle to monetize, right? Like that's just the way my brain works. And I think if people thought like that, the world of opportunity, if you could just get a little creative, the world of opportunity just exists. And and you start seeing that if you use your money and you take control of your money and you invest in yourself and you invest in things you understand, and you mentioned it in your presentation I was just watching, like, yes, the market's going to fluctuate. Yes, there's volatility in certain things. I don't care what you get into. You're never going to get rich playing it completely safe, right? Like, so you have to take risk. But when you take risk in something that you understand. Take risk in something, that you fully aware of. And so I would challenge you, like, how much do you understand about a 401k? Like, a traditional 401k and the fees that you're paying to the administrator and the funds that you're invested in. Like, you don't understand that. Nobody does. Even the person who's like invested in managing your fund barely understands it. I promise. Like, so like get your money somewhere where you can control and invest in something that you're passionate about, and something that you can control the results of. So I actually just went out, and we were talking about this the other day, so I'll just kind of like share it here. I went out and I love off-roading. I love spending time with my family. I love going out with my Jeep and camping and disconnecting from the world. Because let's face it, I run an online marketing agency. I'm always plugged into my device. I'm always like, I work from home, and, I'm always connected. And so I love just kind of getting out. And we talked about, I wanted to buy a camper trailer. And so I went out and I bought this like just totally rad Do people say rad anymore? I bought this totally rad. I bought this
It
totally
works
rad,
when you're talking about what you're going to talk about.
right? Yeah, exactly. I bought this totally rad like off-road trailer that's designed to even rock crawl behind the Jeep, and it's amazing. And so, you know, the MSRP on this thing was $30,000. And so when I went into the dealership, it's pretty cool. And I actually did a YouTube video on this topic. And when I went into the dealership, a lot of dealerships like will sell you on, oh, we got 2.9% interest rates, or like, you know, 0% interest rates. And what I would argue is like, there's no such thing as those, because they're going to bake their costs and their fees into the actual cost of the vehicle. So if they give you a lower rate, they're going to charge you more money, and it is what it is. So I went in and I was able to negotiate down because of the fact that I used a whole life policy, and because I took a loan against my cash value in my whole life policy. And I was able to get that trailer for $19,995.
Whoa, that's a huge difference.
So I got a 33% discount buying the trailer right off the top. But here's the thing. So like, that's first part is like the strategy. You make money when you buy, right? Like that's key, whether it's real estate or whether it's buying a trailer or a car, whatever it is, you make money when you buy. But you can only do that if you have your financial life structured properly to take advantage of the scenario, right? And so, but then here's the thing. I love off-roading. This thing is going to create a quality of life for me and my family. But here's the deal. There's a website called Outdoorsy. Outdoorsy, I can rent this thing out. And I went on and I started studying. I can rent this thing out for $175 a night. So for $20,000, if I rent this out, and I did the math, 4.2 nights average per month, and you know, whatever, I'll get to use it and I'll get to rent it out on Outdoorsy over a 5-year period. I'm getting more than 100% return on investment on this thing that's going to increase the quality of my life. Plus, because of the fact that I'm buying it I classify it as an RV, I get to classify it as a second office for my business. So I get all the tax write-offs to get it at the same time.
Yeah, that's awesome. And I have a similar example of one of my business coaches. She wanted to buy, she's like, oh, I'm saving up money to buy a boat. And I said, okay, the little speedboat, $40,000. And we also did the math of, she said, well, I don't want to use debt. And so I want to encourage you, if you are out there in the audience and you have this mindset that debt is bad. Chris, do wealthy people think debt is bad?
No, you need debt. Like there's a difference between good debt and bad debt, you know?
Yep.
And it's all about financial structure. And like, here's the deal. I talk to people about this all the time. You know, there are different opinions out there about, you know, should you buy a home or should you rent, you know, and a lot of people have the mindset of you should rent where you live and own rentals. Right. And I don't dispute that, you know, like I think owning a primary home is a standard of living kind of expense, right? It's a quality of life expense. But for me, if you're going to own your home, like this is a classic example. And if you can get behind this, then this principle exists in every other area of your life. There are people out there like the Dave Ramseys and Susie Ormans and whatnot of the world that'll tell you that you should get a 15-year mortgage or you should pay cash for your house and like so on and so forth. I'm here to tell you that like after tax breaks and you know, deductions and everything that you get with a house, right now you can get a mortgage, a 30-year mortgage at about 3% and it's just, and when you take it all, your net cost to borrow on your house is going to be in the 2s. You'd be a fool to not, if you can beat 2.9% in any investment, which if you can't do that, you need to call somebody that's going to be speaking today.
Yes. We can all get you more than that.
That's just insanity. Not only that, like, you know, so like it just makes sense. So principally, you have to look at the time value of money. You have to look at how inflation plays into everything. Like people don't talk about that enough, and about inflation and about like what's going on in the world. I think a lot of people like to look at the past and they like to look and say, you know, well, this has been good because of ABC, you know, like whatever variable, this has been a great way to invest over the past 30 years. And I would argue that that's not necessarily the case. Like the environment we live in right now is a completely different environment. Like in the United States specifically, like 1980, the year I was born, it's kind of funny, we've come full cycle. I was born in 1980, 1979 in December, the federal funds rate was 6%. And then in 1981 or 1980, Paul Volcker literally jacked it up to 22% overnight. Overnight. Like, think about right now, if we're at 0% federal funds rate, which basically is the driving cost of every loan, everything. Imagine what would happen if the federal funds rate got raised to 15% tonight and everything tomorrow went from a 3% mortgage to an 18% mortgage. It's insanity. Like, so, it's you have to look at the variables and the why behind everything that's going on. Everything's constantly changing. And so the fixed markets that drive what retirement portfolios kind of in the classic model say that you should be doing, it's completely changed. Everything was built when 401ks, guys, didn't even exist until 1981. Like, it's younger than me, so when everybody's like, this is just the way you do things, it's like, really? Is it? Or is this just kind of an experiment? That's why I love some of the elements of a 401k. If you can self-direct it, some of the tax benefits, and if you could put the money in a place where you can control. But the traditional way of having, doing it through your company and having a plan administrator and putting it in mutual funds and putting it in the market and not having control and all that thing, like, no, especially if you're an entrepreneur and if you want to create the life that you love, like, you need to take a more proactive, engaged approach to your future.
100%. So this, like Chris was saying, if you can have debt that's way cheaper than, what you can get from an investment, like, think creatively. So someone who's watching right now, one of our investors in our last project, he took out $300,000 worth of debt in order to invest in our project, because the debt right now is so cheap, and there's a delay. There's a lot of, with the stimulus, there's a lot of delay in when you have to start paying it back. And so if you can get something at 3% and you can invest it at 20%, like, wow, you're making money on someone else's money.
Listen, there are so many things going on right now in the world. Like, there are so many opportunities right now because of COVID. Like, I'm kind of over hearing all the victimization of the COVID stuff. Like, and I know there's a lot of stuff going on. I don't want to sound like, cold to that. Like, I get it's real, all that stuff. But if you can either look at it and look at it from a victim mindset, or you can look at it from an opportunity mindset. And I promise you, every wealthy person in the world is looking at it as an opportunity. Yes. And when you look at what's going on from Main Street America, and you look at the programs, the CARES Act, the HEALS Act, all these things that have been put into place, you can go out, the regular person, if your money, because let's face it, when you put your money in a 401k, it's tied up, it's locked up. Like, you don't have access to that a lot of times. Maybe you can get a loan in some certain, with certain companies, depends on how the plan's designed, but you don't have access to it. Right now, because of the CARES Act, you actually have access to up to $100,000 of the money in your 401k that you could use for whatever you want. And all you have to do is say on the honor system that I'm experiencing financial hardship, like, because of COVID. Now, I believe, like, for me, like, and once again, talk to your accountant, all those, legalese, disclaimers, right? But, like, that's an opportunity, right? To be able to access your money that I don't think you should have to pay a 10% penalty to access early, no matter what, but it's an opportunity to access your money if you have a good job, if you, like, have a bunch in your 401k, to be able to access that, to be able to put into real estate, to be able to put into a side business, to be able to launch a side hustle, to be able to do all these different things and kind of recapture control of that. Now is just a great time for that. There's other people are putting, I've got a couple clients right now that I've coached. They have $3,000 mortgages. And so what we've done is, because of the CARES Act, you're able to put your mortgage in forbearance, right? And for up to a year in 6-month increments. And so, can they afford their mortgage payment? Sure. But if the bank is going to allow you to put your mortgage in forbearance and, like, not have to pay for a year because of this, and all because you just say, like, once again, you need to make sure you're doing it, you're being ethical and, high integrity about it all.
Yes.
But if that's an opportunity for you to take $3,000 a month in cash flow and put into another investment to create more, and the bank is going to let you take that money, that $36,000 over a year, and lump it onto the back of your mortgage, or have you pay in a lump sum when you sell your property, why would you not do that? Like, it just, other people are taking advantage of these programs. The government has put this in place. And I promise you, if you feel like you can't get ahead, you just got to get a little bit creative to try to give yourself a leg up.
Yeah, definitely. So Chris, going towards the topic of the event, the title of the event, Build Your Legacy. So you help entrepreneurs do this in two ways. You help them build their business and create income from their business. And then you also help them structure their post-paycheck life to create cash flow and these sort of things. Do you do this only for your entrepreneurial clients, the second half of it, or is that something that is also open to other people who are listening right now?
No, it's open to everybody. I just have a passion. Like I said, I was in the financial industry. I just became disheartened with the way the industry operates. And when I first started Life 180, the whole Life 180 started as an acronym leading into financial excellence. And the 180 was all about turning the results in your life around. And so it's evolved since then, and I've created a marketing business behind it. But when I first started, it was literally all about financial education and helping people kind of create the life that they love and just with their money. And so we built in the helping people build, the entrepreneurial agency side of it. On the money side of it, I just believe money is a tool, and everybody needs to just understand how money works in their life. And that, during the, formative accumulation years, or, where you're trying to build more cash flow. And then also, I think, to me, retirement is a 4-letter word, but at the same time, some people, we need to realize that as we get older, we have higher risk of, getting sick, getting ill, having things happen. And so you need to be able to have passive income. It just needs to be there, like never before. And so I have a big passion for helping people do that. I have a big passion for whether it's an entrepreneur. I mean, my YouTube channel at Life 180 I have over 200 videos completely dedicated to this topic alone, right? So it's a big passion of mine because people misunderstand all the moving parts, right? They just, and I think there's a lot of half information out there. And so what I really aim to do is give the full picture and give scenarios and examples and stories and all these things about how people can actually implement. Because once again, what I find is that there's a lack of vision and understanding, and it's hard to have vision to figure out what you could do to implement in your life if you don't really fully understand it, right? Because you can't apply. And so it's that confidence loop. People don't have the confidence to take action and figure out how to plan for their retirement or how to plan for their future, because they lack the competence on the front end. So my goal is to help them build the competence so they can have more confidence. And as they get a little more confidence, then I got deeper, and then they get, and it's just this perpetual cycle. And that's what I love to do. So what we're going to do, and I have a site that's got a calculator. We've got free resources. We've got the YouTube channel. We've got, anybody here and, that wants a free book, I can get, she'll give a link to you. Sarah will give a link to everybody. There's a free book that we've got that anybody can pay. All you have to do is pay shipping. We've literally got the book covered, and it's awesome. Actually, yeah. So it's anybody that wants help, that, if you feel like you need help in this area. One of the things that I'm passionate about is just having conversations with people and figuring out how I can serve people. And from that perspective, if you just go to life180.com, if you want to have a conversation, if you feel like you want a little more clarity, I'll talk to you. I'll give you 15 minutes of my time to have a conversation. That's just kind of the way I try to be and the way I try to run my life. Obviously it's dictated by my time available, but I have a Calendly link in there and everything's easy to go. So if you feel like you need help, I'm happy to help in any way I possibly can.
Yeah, very cool. And to kind of also tie it in and follow up on the the boat story that I was about to start, that's very similar to your trailer story, is that it might seem small. It might seem small, like build a legacy. Well, you're talking about a toy that's 30,000 and a toy that's maybe 40,000. but it's an example of how to do everything in your life, right? And so
Hmm.
the boat example is very similar. If you invest your 40,000 for the boat in something that has a cash flow that will pay for the lease, so this was the suggestion I gave to my coach, was then you're paying for a lease.
Hmm.
So you basically have a free boat from your investment. And if it's in an investment that gives a cash flow and is appreciating, then your principal is still also growing.
Yes.
So you're still building your wealth while your wealth is paying for a lease on a toy.
Amen. Like it's that part is amazing. And think about it this way. This is what I also tell people when it comes to, I do a talk, and it's up on my YouTube channel. It's called the Life 180 Pyramid Talk. And it's all about how to financially structure your life and how to position yourself. Because let's face it, the market is not linear. It doesn't just go up in this one nice 8% line like everybody likes to talk about. It's volatile. It's cyclical. It goes up and it crashes. It goes up. It takes 10 years to go up and it comes down in 6 months. And then it repeats, right? And it slowly trends up. But when you make money, when the really wealthy people, I mean, Warren Buffett has increased his net worth by over $24 billion since the beginning of coronavirus right now. Like, that's not an accident, guys. Like, it's not, so what I say is, like, if you could create a financial structure that allowed you to earn 1% to 2% and be more efficient on every dollar that you ever spent, then you don't need to worry so much on how's my return doing, because the efficiency. The reality is most people in this world are just leaking money all over the place because they're not intentional enough about what they're doing. And so to me, that's the starting point. I mean, I love everything that all these speakers are going to be talking about. It's amazing. I mean, it's phenomenal. But if you feel like you don't have the money to do it yet, if you feel like you don't know how to get started, I'm telling you right now, the first thing to start is you got to do a little bit of a self-check, and you got to have a real conversation with yourself to figure out, like, what am I doing? What am I doing? Is the life that I'm living intentional to actually help me get to where you want to be? I heard this story the other day where there was this golfer, like, Tiger Woods type guy, and he was on the tee and he was hitting balls, and there's this guy in the crowd watching in the gallery, and he's like, oh man, like, because Tiger just drilled it and just like straight shot. And this guy's like, I wish I could hit a ball like that, and then does it again. I wish I could hit a ball like that. And then finally the golfer turns around and he goes, do you really? Like, if you did, you'd stop watching me and you'd go out there and do it. You'd hit 5,000 balls a day. You'd do this, you did, like, and it's the same. It's the concept. It's like, if you really want this stuff, even if you feel like you're behind the 8 ball and you don't know what to do, you can do it. You just got to be intentional about it. And you got to put yourself in a position so you can get that $30,000 to get started. You can get that 50 or 100 or whatever it is for what you want to do. You got to create the critical mass, because you and I we all speak to the fact that it's easier to make $1 million once you've made your first million, right? It's easier to make the second million. It's like 100 times easier to make the second million than it is the first, right? Like, so it takes that effort to get going, but it's so worth it once you do it.
Yep. 100% agree. 100% agree. I encourage you all to, whatever nuggets you just picked up from Chris, if you want to learn more, obviously contact him. I think Anna's going to pop your link into the chat. So
Awesome.
Everyone listening, you'll be able to click on that in order to talk to Chris more. And I really want to encourage you to look at, like Chris said, if you don't think you have the money, I bet you do somewhere. So
Yep.
I all the time, when people say, wow, your investments look great, but I don't have the money, we hop on a call. And one of the things I say is, we're going to do 4 things on the call. And the third thing is, we're going to find you some money, because you might have something you can take a line of credit out against, using it as collateral. You might have some accounts that you can roll over. You might have a planned purchase, like a car, like a boat, like a trailer, that you don't think, I don't have the money to invest because I really want to buy this thing. But instead, if you're using that as an investment, and use the cash flow from that investment to buy your thing, or, like Chris did, like, there's so many creative ways that we can find money for you. So definitely don't think, hey, this isn't for me because I don't have I don't have the lump sum in my savings account. There are so many other ways that we can we can
Totally.
all find money.
Love it.
Yeah. Yeah. Awesome. Well, thank you, Chris.
Yeah, you got it.
I just want to open it up and say, is there anything else you want to say about, for the audience about building your legacy and financial mindset?
Yeah, I think for me, one of the statements and taglines of Life 180 is change your thinking, change your action, change your life. And we all have a life that we're all aspiring to. And one of the things I was blessed with when I first started this journey was I had a mentor who said, if you really want to be successful, go out and find the person that's living the life that you want to live and emulate what they're doing until you get there, until you get those results, right? And so what I realized is like, we all want this life, and the reality is the life that you're creating for yourself right now is dictated by the actions that you take on a day in, day out basis. And, those actions are dictated by the way you think, pure and simple. And for me, the best way to really change my thinking was to read books, to really connect with people and surround myself with people, because you're going to find if you just, plug into the communities of the people that are speaking here, plug into, the right books that of people that have had the results that you want. And then you just follow that. You're going to notice whether you actively go out and proactively implement, you're going to notice it changes you, and it's going to, on a subconscious level, change the way that you act. And so I think that's the first thing. And then, after that, it's just be intentional. It's sad, how unintentional people are in the way that they kind of navigate and live their lives. And they don't think about the cause and effect of every decision that they're making. And, so what I would just encourage everybody to just, be more intentional, change your thinking, change your actions, change your life, go out there. When you do that, you're gonna begin with the end in mind. I'm using all these cliche statements right now, but you're gonna begin with the end in mind, and you're gonna have that clarity on where you want to go. Because if you don't know where you want to go, you're gonna get there every time, and that's nowhere, right? So you really have to know where that end destination for you ultimately is gonna be. Then you can build the roadmap to get there, or you can find somebody that can help you build that roadmap, right? And I think that's awesome. So I mean, anybody who's here that's kind of in that scenario that's looking to build, I mean, I commend you for being here, and I think you're in the right place. And listen to all the information, take the notes, just see how it resonates in your life, and then reach out to people who are doing this, that connect with you. And you're going to find, I mean, if anybody's speaking here, they're here because they have a heart of service. They're here because they want to help people. And, there's probably not going to be a speaker here that wouldn't be willing to have a conversation with somebody, that needs the help and that has the drive and the energy to kind of take that next step. So that's what I would say.
Great point. Great point. Thank you, Chris.
You got it.
I appreciate everything. I appreciate you for being here, about sharing your wisdom, and I encourage everyone in the audience, if you were interested by anything that Chris said, just click on that link and be prepared to learn some more about him.
Thanks.
All right. Well, thank you, Chris. And now we're going to switch over to Mike Brown. Hi, Mike. Welcome. So while he gets turned on, audience. So Mike Brown, I love his story, and this is why I invited him to be on today. He was a wealth advisor with Merrill Lynch, and then something shifted for him. They told him what he could and could not recommend. And so, Mike, I'll let you get into this some more as you tell your story. But I think that's really, really powerful for people to hear. So places like Merrill Lynch, Wells Fargo, those wealth management, wealth advisors are limited in what they can actually suggest to people. And they only make money if they make certain suggestions. And so it's important for you to know the people who are giving you advice, what's in it for them to give advice A or B. How are they, how are they incentivized to give recommendations? And you're paying them a fee, but are they actually making money if they make a certain suggestion to you versus, honoring that they should be giving you what's actually the best suggestion for you? So, Mike, welcome. I love your story of how you shifted out of where you were and where you are today, and how you advise people. So thank you so much for being here.
Thank you, Sarah. Well, you
Yeah.
said it better than I could. I think. Good job. Good job.
Mhm.
Yeah. So, I've been in the wealth management and commercial real estate investment world for a little over 15 years, and we've seen it all. Where this disconnect that you just spoke so eloquently about, Sarah, was when we started running out of capital, just using our friends, family, and current clients to build real estate funds and syndications. We said, look, the most natural place for us to go is to the neighborhood financial advisor. They've got lots of clients that need to diversify their portfolios, up their returns with anemic or predictable Wall Street returns. And so we did that. So we set up a lot of meetings and went and talked with advisors, and they were all excited about it until the rubber met the road. And they're like, no, we just don't think we're going to move forward. And, it didn't take long for us to figure out we were a conflict of interest. We were taking money out from their assets under management is how they get paid. And no matter what, they didn't care about the bottom line of the client. They feel in their minds is true diversification is diversification if it's on Wall Street and under their portfolio management. So my partner and I said, how can we fix this problem? So in order to break down the walls, we created our own wealth management company. So we now bring all the experts under the same roof and are able to really create a truly diversified portfolio for our investing clients. And we've seen our returns drive 3 to 5 times, adding real estate into the portfolios correctly, depending on the suitability of the clients. We are fiduciaries, so the client comes first. So we are cognizant of that. And also reducing risk and exposure to Wall Street. So it's been a great experience, and I'm enthusiastic to spread the message that people have options. They don't have to, be 100% guided by a status quo financial advisor that has a limited vision.
Yeah, and I love that. And I think it's so important. A few things that you said about diversification, first of all. So diversification, a lot of people talk about their stock portfolio, but really diversification it's a huge gamut. And we have some other people we've been talking about real estate, but we also have people talking about startups and other alternative assets. There's so many things out there that you can diversify your portfolio with. And whatever you love, you'll learn about. And
Right.
so I always encourage people to look at everything, look at all the alternative assets out there. And then whatever you think is cool or interesting, you'll learn enough about so that you can make enough money in that investing in that asset. So I like that point that you made about diversification.
Absolutely. Yeah, we call it a 3-bucket approach. So we take a client's portfolio and we show them their allocation among the 3 buckets. The first bucket is Wall Street. So anything that you have invested in a Wall Street type scenario or exposure goes into the first bucket. Our second bucket are the alternative investments, just like you mentioned. It could be real estate, but it could also be gold and silver. It could be private equity. It could be a startup. It could be even Bitcoin. All those fit into our second bucket. Our third bucket are cash, bank, insurance. Things are uncorrelated to all the other 2 buckets. And what's alarming is most of the times we run a client through that exercise, that first bucket is just overflowing because they are overexposed to Wall Street. And depending on their stage of life, it can be very dangerous. We're on a roller coaster right now. The markets this week, even alone, have been on a roller coaster. And, when I ask a client who may be pre-retirement, 60, 65 years old, can you afford to lose 40% of your net worth due to one of these corrections? So it's important to completely allocate across the board to your specific goals.
Mm-hmm. Yeah, definitely.
Yeah.
I would love to hear from your point of view for the listeners. If they're thinking, okay, yeah, I want to shift how I'm working with my money. So maybe they have a wealth advisor at one of these large institutions
Mhm.
who are limited and they want to shift over and work with someone else. What kind of advice would you give to someone like when they're preparing to look for a wealth advisor? And because you've got to have to kind of make some decisions first before you start talking to a wealth advisor. So what should they kind of do pre their research? And then how should they choose a wealth advisor?
Sure. Well, I think the one thing today you'll see a lot of this is the fiduciary word. There's been a big shift from the broker dealer, like the Merrill Lynch's and the Morgan Stanleys, that actually get paid commissions, and they do not have they don't operate under the fiduciary standards. There was an article in the New York Times recently that if Morgan Stanley alone had to work under the fiduciary standards, they would lose $300 million a year in fees. So that was like eye-opening to me, like, okay, this is some real stuff here. So I think first look for an advisor that is operating under the fiduciary standard. So what that means is the client comes first. Whatever fees that you may be generating or any management situations, it's second seat to the client's best interest. So I would say that's number one. And then I would really, ask the potential financial advisor, how do you feel about alternative investments? Can you put us in alternative investments? And there are some firms that have access to private equity, some of the real estate, precious metals, things like that. But the thing I found is a lot of these traditional status quo advisors really just don't have the background knowledge or the expertise. So it's difficult. I think, really diving into some due diligence questions about their particular investment philosophy. Are we going to put it into a mutual fund or an ETF portfolio and set and forget it and call you once a year for a review? That's what you mostly see out there.
Mm-hmm.
So I don't think that is a way to go. So due diligence, education, being on events like you're hosting today. The investor today has got to educate themselves. They can't rely on television commercials and email blasts you may get in marketing. You're not going to get it that way.
Yeah. So I have a story. It was maybe 3 years ago now. My husband and I, we went to, I forget kind of what their title is, but someone to help us with our financial planning to say, like, we have it in our head how we want to do it, but there might be an expert who has a better way. There's always an expert who has a better way.
Yeah.
So we went in and I said, okay, so here's what we're doing. We want to be all in real estate because I don't enjoy learning about stocks. I don't like the volatility. I don't want to be in stocks. I want to be in real estate and I'm open to other things. And I want to be in syndications and hotel development. And he literally said to me, you'd be batshit crazy if you put that much money into real estate and hotels. And I was like, okay, not the person for me. I was like, so what are you going to do for $5,000 a year? They were going to suggest, like you said, even though they were totally independent, they were going to suggest some very safe vehicles that grew at 3% and, put this percent of your money in it and we'll talk to you once a year. And we were like, okay,
Yeah.
no way.
Right. Exactly.
No way. That's not going to get us anywhere near our goals.
Yeah.
And when I said, okay, well, our goals are like, we were very intentional about our goals. When I wanted to stop working, when I needed, our passive income from our investments to reach a certain amount of money. And they said, there's no way you can do that.
Right.
I'm like, oh, but there is. I know how to do it, so you should know how to do it. So I think that's a really important question that you said is that you should ask the financial advisor, what is your opinion of alternative investments?
That's great. Well, first of all, Sarah, you're the traditional financial advisor's worst nightmare. If you came in their office, they don't know what to do.
Yeah.
And it's really interesting. We had a prospective client last week that we're looking to onboard. He likes real estate also, and he's got a number of real estate residential holdings. And he had a modest stock portfolio, but he was very aggressive. He had aggressive goals, and he had a 10 million net worth goal. And so we put him in touch with some portfolio managers to show him his Wall Street side.
Mhm.
After the call, the portfolio managers called me and are like, we're really uncomfortable with this guy because I feel uncomfortable trying to get this where he is today to $10 million. It's not possible. And I'm like, guys, we're not expecting you to grow his portfolio all through Wall Street products to get him to the $10 million. He's starting a new company. He's acquiring real assets. And it's like, you guys have got to step back and look at the whole picture. And subsequently, they sent him a stack of documents to cover themselves because they felt they were going to be put into a high risk trading situation. And I was like, no. You got to look at it from a different perspective. And once again, just more evidence that you've got to step back and make sure you know who you're working with.
Yeah, definitely. And I
Mhm.
think something else that's important to ask, and actually this is for anyone on your financial team. So whether it's your wealth advisor, whether it's someone who's looking to work with me to connect to investments, you should always ask the person how they're getting compensated, right?
Absolutely.
So you get compensated from your client, and maybe there are other ways. I mean, I don't know, I'm not saying the same, I don't know how Mike is compensated, but it's important to know, so you know where they're, even if it's subconscious, might be leading them. So for instance, when I connect someone to an investment, I get ownership in that investment. So I'm only going to connect people to investments that I know are going to make
Right.
money. I don't
Yes.
get a referral fee, because then it's like, if you get a referral fee, like, I'll just refer you to anything.
Sure.
But if I get ownership in an investment, I'm only going to pick those that I've done the due diligence that I know the investments are going to pay out as well. So
Absolutely.
yeah, I
And I think with the fee structure, it's not about what's really there on the table. What you see, there are a lot of hidden fees. For example, a mutual fund could have 3.5% fees embedded inside the fund itself on top of what the advisor may be charging you. I think back to our real estate side, you and I can both agree it's very transparent. And we also invest in alongside our other investors in the deals. And like you said, we have skin in the game. We have to make that investment succeed, because first of all, if we ever lost money on an investment, we're pretty much done in the business. We can't let our investors lose money. So that's our number one priority.
Mike, I have someone, I was just looking at the questions in the chat. Someone's asking, what's the name of your company or your firm?
Red Fox Capital. Our website's redfoxcapital.co, and we are rebranding our wealth management. We're in a number of revisions. It's going to be redfoxwealth.com, where we're going to bring all the different disciplines under the same roof.
Awesome. Mike, I'd also like you to share a little bit about your book and kind of the suggestions that you make in your book and your philosophy in your book, because the event is called Build Your Legacy, and that's what you're helping people do. You're helping people build their financial legacy, and so I'd love to hear kind of broadly what your book is about, and some advice on that.
Yeah. So the book came out last week. Thanks for bringing it out. And thank you. It's called The Real Perspective. It's on Amazon, and it's really kind of a nutshell what we just talked about. It's my journey through Wall Street and real estate, and historical look back on real estate, and the new discipline that we're championing, which we call integrative portfolio management, bringing the real estate inside a traditional portfolio. And I think some of the cool things about it are that we run scenarios showing an S&P 500 portfolio, and then taking allocations and taking that S&P portfolio, adding 20% of private commercial real estate in it. And then we'll go to 30%, and we'll go up to typically about 40%, depending on the person's net worth suitability. And the returns are astonishing. Just by adding a little bit inside that Wall Street portfolio, we're seeing returns drive from 3 to 5% with more security and less risk. So I would encourage everybody, just take a look at that. And, the S&P 500, the mutual funds, ETFs, they all have a place in everybody's life. It's just a matter of what true allocation you should look at yourself for. And then also, if we're trying to build legacy, commercial real estate is proven over and over again to outperform all the investment products we've talked about today. It's just a fact.
Yeah, can you dive into that some more and explain, because you have a longer history in that industry and in that asset class than I do. So I'd love to hear, over time, what you've seen with yourself personally and with your clients.
Yeah, sure. So in the real estate side, we really focus on industrial real estate, retail, land development, and medical office. So, we've seen a lot of changes. I mean, we used to be pretty heavy in general office, but we all know now, even before the COVID crisis, that asset class was kind of moving away. Now, multifamily, which is your cup of tea, is another great asset class where we just don't have experience in that. So we refer everybody to you if they want to be invested in multifamily. But we've seen, from development, the prices have just been very, very strong. I mean, we've lived through the worst recession ever in 2008, and even then we saw property values and rental rates. They were anemic for about a year, but came right back. And you saw that with the lending institutions. If residential properties, the banks were quick to short sale and get it off the books. They weren't in commercial. They knew those assets were going to perform. Let's kick the can, push it down the road. They were going to recover. And that's what happened. And, even today, we were talking in March with the initial COVID crisis, the multifamily guys were freaking out too. I mean, we were projecting massive defaults on rental payments. It just didn't happen. We saw maybe a 2 to 3% decrease, it's nothing, and it's come right back up. Obviously, some of the small retail players have been hurt, but even in the small regional shopping centers, we've seen a rebound, and the tenant turnover is pretty quick. We like to call that Amazon-proof retail. So it's the things that Amazon can't take over, like a nail salon, a dry cleaner, your local restaurant, things like that, that are always strong, and we like it.
Yeah, and if you're out in the audience right now and you're like, oh, I didn't know that these are things that I could invest in. How do I invest in them? Like, just as a single person who I don't have knowledge of it. Can you explain a little bit how that would work?
Right. So let's first start with what the traditional financial advisor would tell you. So if we walked into Mr. Advisor on the street and I said, I want to be in commercial real estate, I want to have exposure, the first thing they're going to do is recommend you buy a REIT stock, real estate investment trust stock. So that's just a consortium of assets, and is traded on the exchanges. What we're saying to Mr. Client is that's really not exposure to real estate. Those stocks, REIT stocks, correlate directly with the stock market. So we have to immediately change our way of thinking. So back to private commercial real estate is what I know you do, and what we do some is create either syndications, or we create one-off funds, depending on what the asset class may be, the strategy. So for example, if we're doing an income producing fund, the investor would come in, we would operate as the general partner. They'd be limited partners in a private placement memorandum structure. Mm-hmm. And we would set a preferred return on that. So if they can invest, we typically will take investors as low as $50,000, up, and we have maximums also. So they would come in, they would get the preferred return set. So for example, right now we have about 8 or 9% preferred return. So that's going to be the amount they know they're going to start getting on a regular basis we call it mailbox money. Mm-hmm. At the maturity of that particular fund, we're going to sell the portfolio and we're going to have a large windfall. And then we just prorate that out and everyone gets a large piece of the profit. So typically in those deals, the less risky deals, we'll see anywhere between 11 to 16% internal rate of return. The more risk profile would go up. So like a new development where there's a lot of risk in the front, you should look at maybe 19 to 20, low 20% returns. Mm-hmm. Anything above that we call red flag area. That's too good to be true, or the risk profile is just too high. So that's pretty much it. It's very simple. So you join the partnership or the fund itself and start collecting checks.
Yep, there you go. So yeah, that's exactly the structure that we have. Same private placement memorandum structure and everything like that.
Yeah.
Yeah, just different asset class. So like I mentioned, whatever interests, if you're in the audience, whatever interests you, learn more about that, because it's probably something you can invest in. So
Absolutely.
I
Yeah.
was I was interested in multifamily. It made sense to me. It felt safe to me. People always need a place to live. So that's where I went deep. But if, like Mike was saying, if there's something else that interests you, learn more about it, go deep in it and invest there. Or
Right.
invest in all of them, like
Right.
REITs. A lot of people say, oh, I want to invest in a REIT because then I'm diversified, because it's a fund of a lot of things. And I totally disagree with that viewpoint. I think you should diversify yourself. So if you have 100 to invest 50 here and 50 there, and then you're diversified in something specific that And when it's a private placement, like what you were talking about and what I do, then it's much more efficient. It's much more efficient, and
Right.
we're not investing in things that we don't know are going to be really great for our investors. But when there's a REIT, when there's a large fund and they have to place a certain amount of money,
Mhm.
sometimes they just pick the best that they can find at that time because they have to place money in a certain amount of time. So
Yeah.
it's not always the best returns, even though it might be
Yeah.
diversified in some sense of the word.
Right. Well, Sarah, we talked about that the other day. I think that the smaller funds operate much better than larger funds, the household name funds like Blackstone, Carlyle, Starwood, and they raise billions of dollars of capital. And when you have that much money, it's very hard to place. It's very hard to find the right properties to meet all the requirements that we would. And to get the returns for the investors, they got to place that money as quick as possible. And a lot of times they will come out to us and say, okay, we want you to be the source or operate this. And they've got now starting to creating middleman fees. And so you got to be very careful about that. The smaller funds are more nimble. Their dollars mean more. They're closer to the deal. And it more than likely always comes out that they can produce better yields than the larger funds.
Yeah, 100% agree.
Yeah.
Creativity is the most important thing, I
Yeah.
think, when looking for team members. So that's what I think when I'm looking for partners and when I'm looking for people that I'm going to invest with. So for
Mhm.
instance, solo 401k, I can't invest in my own property, my own project. So I'm looking for someone. So I was on the phone with someone last night and she was telling me about examples of things that went wrong and how creative she was to fix those.
Mhm.
And I was like, whoa, you are so creative. I feel like, yeah, because in real estate, nothing goes 100% according to plan, right?
Clearly, if it does, you should be worried.
Yeah.
This is too easy.
Yeah, there's always something that goes sideways. So you want to be with a creative team who can switch. And so, like you said, when you get to those really large funds, they have processes, procedures, execution plans, procedures. And so, like you said, the less nimble, their ability to be creative is smaller. And so I totally agree with you.
Well, I'll tell you a funny story. Back
Yeah.
it was probably 2007, 2006. We were representing a office building near Washington, D.C., our area. And we got a phone call from somebody in Miami, Florida. And they said, hey, we're a private equity group in Miami, and we own this building now. But we don't know who's in the building. We don't know the tenants. They've never seen it ever. So they wanted a feedback from us about who were actually in the building, who the tenants were, and the status of the building. And it just shocked us how this lazy money is out just taking deals, not knowing anything about the actual property. And we promised ourselves that we would never do that. It's crazy. It's crazy.
Yes. Awesome.
Yeah.
Well, Mike, is there any kind of going back to the build your legacy, is there
Mhm.
anything that you'd like to tell the audience about either mindset or strategy or tactics if they're looking to kind of shift what they're doing today? What are some first steps that you would recommend in order for them to start acting, planning, doing, taking action like the wealthiest clients that you work with.
Right. Well, I think Chris said it earlier best. I mean, you have to set your intention. I mean, know where you want to go. If you don't have a end game, end goal in place, you're never going to really get there, because there's going to be a roller coaster ride. So first, that is, let's figure that out. If retirement is your main goal, what does retirement look like to you? We like to ask our clients, tell us your dream retirement vacation. Like, let's figure this thing out, and then go from there. And say, okay, if we need this much to live on, if we need this, do you have legacy, estate issues? Let's get this down on paper, and then let's reverse engineer it, and let's show you how we can get there. Whether it be allocating into real estate, other types of products. You've got to set the intention and set the guidelines so we can get you there. I can help you get there, but after you make some mistakes, it's pretty hard for me to recover, especially when you're older and getting near pre-retirement. You lose 50% of your money in Wall Street. There's not much I can do other than tell you to get an extra job.
So I think a big moral of the story in that case is get started early.
Absolutely.
So, yeah, I gave an example to my audience of, $50,000 today in my solo 401k, investing that in a syndication that'll yield 20% return. So basically doubling your money every 5 years. By the time I'm 65, that's 1.6 million.
Right.
And get 8% on that. That's a piece of it. But if I started doing that when I was 55, that's not going to be 1.6 by the time I'm 65. No. So the earlier you start, right? I mean, there's so much more you can do.
Everybody you spoke with says, I wish I started earlier. You never hear anybody say, I started too early. It's always looking in the rear view mirror. Mitchie, if I can add one thing about the 401k you mentioned, a lot of our clients are using the COVID-19 stimulus plan to move money out of their 401ks into alternative investing like we're talking about.
Well, it's in solo 401k, so I can put it in alternative.
Yeah. But for people that are, are employees, have their traditional 401ks, that are stuck captive in probably mutual funds and such, the new stimulus plan allows us to take out $100,000, pay your taxes, reinvest after tax dollars, with the theory that we are in a low tax environment and we're going up in taxes with the national debt. So
it can only go up, right?
It can only go up.
It'll be going up until my kids are retired.
Right. So it's a good strategy to take that money out. And the reason because of the CARES Act, there are no penalties associated with taking the money out early before 59 and a half. So it's a great opportunity for people to get out of that captive 401k and maybe put it into, like you said, a self-directed, like you do, a solo 401k that you can now control.
Yeah, there's so many creative things right now.
Absolutely. Yeah.
Definitely.
Yeah.
Well, Mike, thank you so much for joining us today. I love what you shared, and I hope for all of you audience members out there listening on the YouTube Live that there were a bunch of ahas. And, Mike is working with very wealthy people, but it doesn't mean that the strategy should be different for anyone else. And that's the key thing, getting started early, learning how to take control of your finances, learning what the wealthy do, and then try to do that yourself on whatever scale you can. Will help you grow, help you get to a point where you can leave a legacy faster.
Absolutely. Thanks, Sarah.
Yeah. Thank you very much for being here, Mike. And we're going to have a joint webinar someday soon. So for all of you listening, you'll probably see Mike again.
Okay. Thanks, everybody. Good luck.
Thanks. All right. So up next, we have another Chris Lustrino. And there you are. Hi, Chris. Welcome.
Hey, how are you, Sarah?
Very good. Thank you for joining us.
Yeah, of course. Thank you for having me. I'm excited to be here.
Yes, definitely. I'm excited you're here too. So I don't know if you've been listening, but we've been talking about real estate. We've been talking about retirement investing. We've been talking about investing for passive income, for cash flow, and most of all, diversifying finding what interests you, learning more about that, and then investing in that. So I think what you do is super, super cool. So I'll just take a moment to give a story to everyone. So I work at a startup. We just got purchased. We announced it last week. And so I had some options. I'm going to make some money off of this. And, living in Silicon Valley in the Bay Area, so many people are trying to get jobs at startups that they think are going to get acquired or go public, because that's like the way that we know to catch that windfall on a startup. But now I didn't know this, but when I met Chris sometime last year, and he started talking about, do you know that there's crowdfunding for startups? Do you know that you can invest in startups yourself? So even if you don't live in Silicon Valley, even if you aren't sure like what startup to invest in, you don't have to know someone who has a startup. There's now technology and crowdfunding in this area, and it's a beautiful thing. It's a beautiful way to take advantage of startups, even if you can't be an employee of a startup.
Yeah, I think that's exactly right. And probably the best part is that you can actually now build a diversified portfolio and invest in tens or hundreds of startups with minimums in the range of $100 or $500. So instead of having to put up 50 or 100K into any one deal, now you can put in $100 and you can put that in 10, 20, 30 deals and have this amazing diversified portfolio where if a few of them hit, you could end up really seeing some nice outsized returns.
Yes, it's very cool. So Chris, why don't you talk about King's Crowd, what it does, your journey to King's Crowd, because I think it's all very cool. So yeah.
Yeah, I'd be happy to do that. So, my career actually started in management consulting several years ago. And for those who don't know, management consulting, oftentimes you're either working on behalf of corporations or with investment funds of some sort that are looking to do deals or looking to improve the operations of their company, whatever it may be. And we kind of come in and help. And so one of the things that I spent a lot of time at in that job was actually doing private equity due diligence. So literally, any company that's not trading on the public stock exchanges like NASDAQ and New York Stock Exchange that aren't available in your Robinhood or your Charles Schwab or Fidelity account, these are private companies, right? And traditionally, the way private companies are transacted, if they're not public, is through major private equity funds and venture capitalists. And so we would actually go and do the due diligence on these companies before they were transacted. And I think one of the major findings for me was, one, there were a lot of inefficiencies in the traditional private equity world. But two, I was like, this isn't that hard. You do some market research, you learn about the company, and suddenly you have a pretty good sense of should I invest or not. But because non-accredited investors, which are non-millionaires, representing 93 to 97% of all of us, up until 2016, we weren't allowed to invest in private companies. It was literally illegal. And the idea behind all of it was, hey, we shouldn't allow people to put their money into risky things that could end up putting them in a compromised situation. But the reality is the private equity asset class and venture capital is probably the highest growth, most exciting asset class that you can invest in. And there's a reason that all wealthy people are invested in it, because it's a great way to continue to build wealth. But until 2016, it literally wasn't available to the general public. So that all changed thanks to the Jobs Act. It's probably one of the few things in government today that are actually Republican and democratically supported. And it's a wonderful thing. So over the past 4 years now, we've seen the creation and fruition of 50 plus marketplaces. We call them online private markets, where anyone can go and invest in equity in private companies from pre-seed, when the company like Google is still in the garage, to pre-IPO when it's a unicorn like Airbnb and it just hasn't gone public yet. And there are billions of dollars pouring into these companies from millions of investors. It's pretty incredible. And so what we've built is essentially a tool that aggregates all of the deal flow from across every one of those marketplaces, brings it into one universe, and actually provides a quantified rating on every one of the companies. Because at any one time, there could be 500 to 1,000 companies you can invest in. And what we want to do is we want to narrow that universe for you and get you to the companies that are actually worth time, spending on due diligence and things of that nature. So we're helping to empower people to make informed investment decisions in this new private market landscape, which we think has an opportunity to really create a lot of chance for value creation in people's portfolios. But we do think that over the next 5 to 10 years, this will become a ubiquitous part of everyone's investment portfolios. So think of us as Bloomberg or Morningstar. If you use any of those tools, that's basically our service, but we're doing it for this new online private market space.
Yeah, thank you for that. Super is a super cool thing. Because after now working in a startup, yeah, it's probably the last startup I'm going to work in. But I believe 100% that it's a great way to build your financial status. It's helped me and my husband tremendously, and it will continue to do so. And so I'm definitely going to be digging in and looking deeper into what you do and how you do it. There was one I should have looked before this chat, but when we chatted last year, there was one thing I invested in, and I can't remember what it was now. I should check and see how it's doing. But yeah, so very cool. So Chris, could you tell us, a little bit, like if someone wants to go in and get started, like how would you suggest because like you said, there's so many, like what would be a first, second, and third step for them to learn about how to start investing in startups?
Yeah, so I mean, and this is no tooting of our own horn at all, but if you want to learn, I absolutely recommend going to King's Crowd. And we have tons of education and blog content and just learning about what is startup investing. If you don't want to use King's Crowd, that's fine. Go on Google and say, what is startup investing? There are also some wonderful books about startup investing and also just in general learning about startups, right? What are the main differences between a startup and a private company versus a public company that you're traditionally used to investing in, right? And essentially it comes down to early stage companies that are private tend to be much riskier with a lot of upside, but they could still go to zero very, very easily. They're still in the early days, right? And your public companies are essentially well-established companies with lots of history that have shown success before with very experienced management teams, and the odds of them going to zero are much, much less likely, but the upside might be limited, right? So that's kind of like the two big pillars to understand. But, like I said, I think it's really important to just go start reading and understanding. And I think, a couple of the few principles that you should understand is that when you're investing in early stage and private companies, you are taking on more risk, and you're also often talking about long-term investment horizons. So this is not something where you put in $100 today and tomorrow it's going to be worth 200. You're putting in $100 today and you're hoping there's an exit or an IPO in 5 to 10 years. So you're locking your money up and saying, I believe in this idea for the next 5 to 10 years of its journey. So recognize some of the key parameters of investing in startups. But then once you've kind of gotten comfortable with the asset class and say, yes, this is something I want to be a part of. I see that if I put a small percent allocation of my money into startups, there's a chance for outsized growth within this part of my portfolio. Okay, great. I'm going to allocate 5% of my dollars every year to this asset class. Then I think a really wonderful activity for anyone to do is come up with, what is your investment thesis, right? What do you believe in? So before I started this company, I actually had written an investment thesis that over the next 10 years, basically fintech was going to, reinvent the financial services industry across several sectors, from wealth creation to savings and management, all these types of things. And so I said, my universe of what I want to invest in are things that align with that thesis. And you could come up with whatever that is. It could even just be an interest. I love apparel and fashion, and I want to, invest in the future of apparel and fashion. Great. Now you can look for companies that fit those criteria. And then the next thing that I think is worth doing once you kind of know about the asset class, you know how you want to invest in terms of your thesis, then is to go and do your research, right? So go on the various platforms, republic.co, wefunder.com, seedinvest.com, startengine.com. Go on King's Crowd, use our ratings tab where you can actually search and filter. So if you want to invest by sector, great. Look up by sector what companies are available for investment. If you want to invest by stage, be it valuation or whatever it may be, great. Go and put in the valuation that you want to look at. Whatever it may be, you can search and filter and find those companies and just start reading those pitch decks, start learning about those companies, get comfortable with kind of the terminology. And I think at that point, once you're comfortable with all of those various components, then you can take the step of saying, okay, I want to make my first investment, and start small. Don't put 10,000 in the first one you see. When you said you wanted to allocate 10,000 this year to startup investing, put 500, maybe 1,000 if you feel really confident about it, but 250, 500, and try and put in 10, 20 companies in your first portfolio.
Well, that's a lot. So if you're doing 20 in your portfolio, how much time do you think someone should spend evaluating each of those 20 companies?
So, I would say anywhere. So if you're going to be putting in $250, $500, I think Let's take for each $100 you're putting in an hour of your time, right? Maybe it's 5-6 hours that you want to spend kind of getting a feel for the company. And that doesn't all have to be in one sitting, right? Maybe you go and you look at it and you get comfortable with the idea, and then maybe you listen to a webinar with the founder, maybe you keep tabs on their updates that they send out. So you can do these things in a passive way, but just get comfortable with, hey, I'm seeing progress here. I like what they're doing. And then, at King's Crowd, listen, that's our whole job, right? Our role in all of this is basically be your research partner. So we go and we do the work. We have, a whole full-time team of investment analysts that this is all they do day in and day out. They see the deals come in the door, and then they go through all of the analysis, they collect all of the data, they go through iterative processes where they talk to each other about how they feel about all of the various elements of the business. So honestly, when you come to King's Crowd, you can use our market scan tool. You come to your small universe of companies that matter, and then you can check out our reports, and hopefully that gets you, 50, 60, 70% of the way there with your comfort level. And then you can, make sure you ask the questions that you care about, get those answered, and then you're probably good to go.
Yeah, very cool. And who would you say is like your typical, I wouldn't say King's Crowd client, but I guess King's Crowd user?
Sure. So, it's funny, our typical King's Crowd user, because we're still early days in this market, right? I mean, a 4 or 5-year-old market is very, very immature in the world of financial services, where most of them are, 100 years plus, right? So we're still in the early days, and most of the people in it are early adopters. But one thing I would caution against is we don't want to encourage what the early adopters look like to be what the future looks like. So, it is still a lot of people who are in financial services. It is still, more male dominated. It is still, slightly higher income. But I don't think that that's necessarily what we want to see. We want to continue to bring in, various parties that should be in this space. And if we want to be backing female founders, let's get more females in the door who are, investing in them too. And let's teach them that they should be investing in this asset class. So I think we want to see that evolve, and we're trying to build tools and resources to make it more accessible to a broader population of people, because what we want it to be representative of is everyone, right? Because at the end of the day, the coolest thing about all of this is up until 4 or 5 years ago, the venture market, 90% of the funding went to 3 cities, Boston, San Francisco, and New York. And basically it went to white males from a handful of universities within those, right? So this whole thing changes that equation. Now the online private markets have already supported companies in all 50 states. So it's already doing a way better job than venture has ever done. And the level of minority and female founders getting funding is, in the 20, 30, 40%, whereas it's been 1% and 2% in the traditional VC markets. So it is diversifying who is getting funding, and we need those who are funding it to also look like that and have that representation, because I think we become a much stronger community when we do that.
Yeah, I 100% agree with that. And that's one of the reasons when I started in syndications and I started talking to people about the types of returns they could receive and what the structure was like, pretty much everyone I talked to said, why have I never heard of this before? And like you said, from the Jobs Act 2016, before the internet, before the Jobs Act, I couldn't just go on a webinar and say, hey guys, want to invest in this thing? Here's the returns. This is how it works. There were different rules about how I could speak about it. So I would speak to someone one-on-one and they had never heard of it. And they would think, oh, this seems like too good to be true. It seems kind of scary. And so who ended up investing, when I learned about this, they would say, go to the family offices, go to the uber wealthy. And they were already the people who knew about it. And so I didn't have to explain to them what it was. They already knew what it was. I just had to explain the deal to them. And that's, okay, that's a way to do it. But similar to you, I thought well, I would have liked to invest in one of these, 5-10 years ago. And here I was stuck in my 401k getting 5% or whatever it was, just because I didn't know that something else was out there. And so I'm on a very similar mission with all these summits and webinars, is to reach more people, to say there are so many options out there, whether it's a real estate syndication, startups, like you said, they're for everyone now. Everyone can participate in these alternative investments. And So for audience listeners, maybe you're like, real estate is totally not interesting to me. Maybe startups are, like
Yeah,
Chris said,
absolutely.
like maybe fashion startups, maybe tech startups, whatever it is, there's really cool stuff happening in all those spaces. So that can be a way that you invest. If that's what interests you, then learn enough to invest that way.
No, 100%. I mean, it's been pretty cool. We've actually raised basically all of our funding. We were founded 2.5 years ago now. I've raised about $1.5 million. That's come from 2,100 investors who now own about a quarter of our business, which is incredible, right? And I've had people who are billionaires who have put in 150,000 into the company. I've had people who were, friends from childhood who've put in $100. And I've gotten to go to so many events and talk to so many people, and it's amazing. I mean, I've met people who own vineyards. I've met people who are janitors. I've met people who are veterans, and all of these people are invested in King's Crowd, and they all believed in it for a different reason, right? But when you think about opportunity in kind of the startup world, I mean, imagine having invested in Uber, right, as an example. And this is this is the lucky story. This is the one everyone hopes for, and it's not going to happen that often. But if you had invested $50 in Uber back in 2008, it would be worth $1.2 million at the IPO. So it just says to you, if you invest early and you believe in these companies and you give them their early backing, your opportunity for outsized growth, it's absolutely there. It comes with all the risks. It comes with all of the lockups of having your money there for a long time. All of those things are exceptionally true. But the other reality is that you get to back a founder who believes passionately in what they're doing. And if they succeed in a big way, you do actually get to partake in that.
Yeah, and I think something that you just said is really cool because it's like a double support of the title, Build Your Legacy. So when you're investing in someone's company, you could potentially be building a financial legacy for yourself, but you're also helping those founders, that company, build a legacy for themselves, but create a legacy in their industry, in their space. So Uber created a legacy, right? Like
Yeah.
Uber is going to be a thing, even if it just like deteriorates, it's always going to be in the history books. And so when you invest, if you're helping other people create legacies, you're helping create legacies in industries and the world. It's very cool.
Well, I think it's pretty neat. A couple of our investors, there's one gentleman who's invested in our company, and he said, "Listen, like this is going to be a long endeavor that you're on." He's like, "I'm not even sure if I'll be here for the whole thing of it." He's like, "But." He's like, "I have grandkids that I really care about, and I want them to know that their grandfather invested in things where he believed it could really be transformational." And when he thinks about taking this private asset class that has always been hands off to the general public and making it accessible to everybody, that to him, he feels is a really transformational thing to do for the world. And it's a way to create financial wellness for millions of people if you put this asset class in their hands. And that's what we're helping to do. And so for him, he said, I think you're going to have an incredible return on your company. He said, but more so, I think you're going to build a wonderful legacy that my grandkids could go and say, wow, I'm really glad my grandfather invested in that company early and gave them a chance to succeed. And that means a lot. I mean, I think that's incredibly important. And, when we're approached by, right now we are being approached by some of the largest financial services companies in the world. I'm talking about top 10 size companies, right, in the world. They're approaching us now. But who helped fund us to get to this point where people are actually paying attention to us on the largest scale? It's those 2,100 investors who put in the 100, the 500, 1,000. And they're the ones who saw it before any of the big industry did, right? Like the big industry had to be convinced. These guys actually made that happen. So it's a really special thing to get to be a part of the journey of building a startup.
Yeah, super cool. So Chris, I have a question for you. So you're building this startup, so you're creating a legacy for yourself via King's Crowd, disrupting the space, changing the space. So that's a certain form of legacy. I'd also like to hear, your idea of building a legacy and how you've done that for yourself and in your life.
Yeah. So I think for me, I kind of like the idea of, creating a mission statement for yourself, right? It's almost your investment thesis. What is it that you believe? And for me, I kind of, when I left college, it was, hey, I want to change the world very simply at the very, very top level. If I do nothing else, if I end up poor, if I end up rich, I want to change the world in some meaningful way. And I thought about my passions and the things that I genuinely care about and I deeply care about. And those were along the lines of financial wellness and financial services, because for me, since I was a young kid, I've been really into stock investing and I've really been into business. And a lot of my family wasn't. And actually, they found it kind of discomforting, right? And they didn't understand it. And so my whole thing in building a company like King's Crowd is this idea of making investing accessible to anyone, making a more empathetic financial services company that's honest and transparent and something that people can trust. It's reinventing the way people think about financial services while hopefully improving their financial well-being by taking a passion of mine and doing something about it and trying to be that change that I want to see. And so, I have a few facets that I'm really passionate about: social justice when it comes to criminal justice and things of that nature. And so when I think about the steps that I'm taking, it's, build amazing companies, build amazing nonprofits, and build, amazing organizations in other verticals, right? So if I can prove out my model in financial services, which is the one I'm most closely tied to, I'm going to have the chance to move into these other things that I really care about and continue to scale the good that I can do in the world by utilizing my influence, by utilizing the dollars I create, all of those things to create that goodness to hopefully change the world for the better. So I think for me, it all starts with, okay, how can I change the world? And then working back from there and saying, what are the goals and steps I want to reach over the next 2 years, 5 years, 10 years? And right now, I'm investing a great deal of myself in creating King's Crowd, because if we're successful, we will have made the private asset class that has never been accessible to the general public a mainstream asset class. And people won't even think anything of it to say, hey, what's the King's Crowd rating on that company? And if we do that, we'll have done something really, really wonderful. And then the door is open to do all of these other things that I really care about.
That is a beautiful mindset, a beautiful way to look at it. I think a lot of people think of legacy as a financial legacy or financial wealth, and I'm guilty of that too. But I think it's really beautiful that there's so many other things, like you said, that when you think of creating a legacy, there's so many non-financial ways to create a legacy.
100%. And all of these things tie, right? If you put good into the world and you get to know great people, I mean, for me, business is just a collection of people, right? It's just people working together to make something happen. Like, what is business? It's just a whole bunch of people working hard towards a common goal. Like, that's really all it is. And so for me, if I do an amazing job with King's Crowd, well, all of these wonderful people are people I can continue to work with, and I can continue to raise capital from, and I can continue to, create new things with. And so it's basically just this amalgamation of building almost like these friendships and these relationships with tons of people that you can use as your network to create good. And that's kind of my general thinking is, if you put good, in, you'll get good out.
Mm-hmm. Beautiful. Well, thank you, Chris. I did want to mention one last thing. So we're putting a link in the YouTube chat with everyone's free gift. And you had a link, if you want to explain. So there's two parts for, I think it's Anna, you're posting them. There's a link and then there's also a code. So do you want to explain to the audience what that is and how they can take advantage of it?
Exactly. It's essentially to sign up for one of our subscriptions and start utilizing our product. I'm forgetting the exact, I think we gave like 20 days free or something of that nature to just go and try out the different services that we have on our site. And so the link is essentially just bringing you to the actual website where you could sign up. And then the code, you just put in the code on the sign up page and you'll be good to go. But it's, go sign up for King's Crowd, start reading around on our education and, our learning stuff. Then go and check out the various companies that you can find on our platform, start learning about those companies. And on every one of those company pages, you click through and you can hit invest now and you'll go to the different platforms. And so you'll get to start to learn about the entire universe from kind of one lens. So hopefully it'll make you more comfortable and feel as though you do have kind of that partner in trying to figure out all of this startup investing stuff.
Yeah, very cool. And do you guys have a lot of like educational material on King's Crowd so that if people are interested, that they can go and start learning more?
Yeah, so we have a blog section on our website, and if you go to the blog section, we probably have 200 or 300 articles, and literally every one of them is breaking down a different element of startup investing. Starting with, what is startup investing, but then, talking about different security types. What's a common share versus a preferred share? Talking about different stages of companies. What does it mean to be a really early stage company versus a growth stage company? So we break down all of those various factors so you can find tons and tons of content.
Very cool. Very cool. Well, Chris, any last words that you want to share with our audience?
So, I think for me, I always joke, about 1 million people have invested in startups over the past 4 years since it became legal for anyone to be able to invest in this asset class. When I say 1 million people, I'm focused really kind of in that non-accredited space, which represents, 93 to 97% of all of us. What that tells me is that 299 million people in the United States who now have access to this asset class haven't invested in it. And I think there's a lot of fear, there's a lot of unknown, there's a lot of not understanding it, there's a lot of just not knowing at all, right? Just being completely unaware that this exists. And what I would say is, yes, there's probably things you've heard about, the risks of investing in startups and the challenges of it and da 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 da. A lot of those barriers have been removed in terms of making the financial burden not very big to get involved, right? $100, you can get started. Yes, all of those risks actually exist. Yes, we're going to teach you about those risks. But the reality is, taking small sums of money, 5% of your overall portfolio or less, or whatever you decided. I'm not a financial advisor, but whatever you feel comfortable with, a small allocation, and you say, here's a few dollars I'm willing to lose, but I want to try and learn. I want to try and, get involved in trying this out. Just do it, right? Just try it out and experience it. Because I think once you start to do it, one, it's exciting, it's fun. And two, you'll learn along the way, right? I made some investments 4 years ago when this first became legal. And, I invested in some inexperienced founders who didn't have a lot of industry experience within their sector. And I watched them fail and I went, that was a really good learning. And that's actually part of our ratings model, is looking at that team experience and things of that nature. So put yourself out there, try these things, because you will learn something and you'll continue to grow. And the sooner you get started with all of this investing stuff, the better. And you might as well get out there and give it a whirl.
Yes. Thank you so much, Chris. That's great advice. I think it's so cool what you're doing. Thank you for having King's Crowd and growing it and your mission. And thank you for sharing that with everyone in the audience today. Thank you for being here, Chris.
Yeah, it's my pleasure. It's been a lot of fun. Thanks so much. And good luck to you. And I hope the rest of the day goes very well.
Thank you very much.
All right. Take care now.
Yep, you too. So I see in the questions that some people are asking where to enter the code. So it's kind of hard to see, but there's a place to put in there's boxes to put in information. And then it just says in, I think, red capitals, it says enter a code or something like that.
It says have a coupon code.
Oh,
yep.
Have a coupon. Yep.
If you click on that, then you'll be able to enter it.
Yeah. So you have to click have a coupon ? And then you can enter it.
Awesome. Thanks so much.
Yep. Thanks for clarifying. Cool. All right, everyone. So we have spoken to 3 speakers today. We have 3 more left. I will let you know. I'm just going to stand up here because I've been sitting down. So if you've been sitting down, stand up, shake around, get your blood moving, because we have some more people to talk to. So we have 3 people coming up next. So we have Anton, who's at Peak Financing. He's going to talk about, he's a commercial lender. So he's lending millions and millions of dollars to people who are investing in real estate. He's going to talk to us about what he sees going on with COVID. We have someone who's going to talk about tax planning. You don't want to miss that. You can ask your tax questions. She's great. She's my financial she's not my financial planner. She's my tax strategist. So once you start getting into all this investing, sometimes there's a lot of tax questions. She's going to talk to us about that. And then also, last but not least, we have Kaaren. She's the CEO of UDirect IRA. She's going to talk about what you can do with your retirement accounts in order to invest in all these great things that we've been talking about. So maybe you didn't know the ins and outs of how you can invest in alternative assets with your retirement accounts. She's going to talk about that. So just wanted to let you know that there's good reason to stay for the next couple hours. We have those great speakers. Again, stand up, move around. I'm going to refill my water, and then we're going to have Anton jump on. If you need some more water, grab it. It's not an official break, but we don't want you to you know, not have enough water, coffee, or whatever you got going on. Okay. All right, Anton, why don't you come on in and join us? There we are. Hi, Anton. How are you doing today?
Hi, Sarah. Find yourself?
Very good. Thank you. So like I said, everyone, Anton is in the commercial lending space, commercial real estate lending. So he knows what's going on. Like I said earlier, there's a lot of people think like, oh, the real estate market is scary right now. And Anton, I'm really looking forward to hearing what you're seeing in the real estate market. And I'm going to ask you a ton of questions about like residential versus commercial versus this versus that versus this city versus that city, because it's not one big market, right? There's a lot of nuances. And are you seeing a lot of opportunity out there right now? So I'll let you do a little more introducing of yourself, Peak Financing, what you guys do, how long you've been doing it. You guys have a great history in the space. I'm looking forward to learning from you.
Yeah, thanks for having me on, Sarah. It's really a pleasure to be on with you. Again, my name is Anton Mattli. I'm the co-founder and CEO of Peak Financing. That strange accent, even though I have been living in Dallas now for 15 years, obviously is not from Texas. I was born in Switzerland. Right after school, entered into banking, worked in New York for 5 years, Tokyo for 4 years, Hong Kong for 3 years, and then I left banking directly and helped family offices with their direct investments in various industries, as well as a big chunk of it in commercial real estate. And that was the reason why I came back to United States, because the opportunities when it comes to commercial real estate have always been very good in the United States. And our firm, we are, as we call it, a financial intermediary. We find the right financing solution for a particular project, for a particular property in a certain submarket, as well as for the sponsors. As you know, there are hundreds, if not thousands, of suitable lenders out there on paper, but in reality, it's really difficult to identify the ones that actually can do the financing that you need as a deal sponsor. And so that's what we do. And we have been doing this now for our combined expertise of our originators is probably around 100 years. And we have individuals that work on the Fannie side, on the Freddie side, that were actually involved with some of the newer programs that came out with Freddie. So we have a very deep bench of knowledge within our firm, and that helps to identify the proper lenders. And more importantly, once you're under loan application, we help that you can get through the deal without any problems, so that you do not face a retrade right at towards the end of the deal, which is kind of the nightmare, as you know, Sarah, for every deal sponsor, right?
Yes.
Yeah. So you mentioned COVID-19. Obviously, it's on everyone's mind, right? Now, this certainly has thrown a massive stick into the wheel of commercial real estate. Commercial real estate has really been on a major run over the last 10 years, essentially. Obviously, we came out of the Great Recession with a lot of issues. A lot of properties had problems. A lot of owners had problems. And real estate prices, including commercial real estate, as well as multifamily as part of commercial real estate, suddenly the values dropped quite significantly during that time, anywhere between 20 and 30%. So whoever started to invest during that time obviously was in an ideal spot and had the ability to go through a massive run-up over the last 10 years. And everything looked really good until COVID-19 hit. Even for this year, And with COVID-19, I think a lot of fear was already in the market that we have been going through a bull market that already lasted well beyond of what everyone was expecting, right? Many of us, I thought already in 2018 that we kind of reached the end, and then we have seen 19 and it was still going strong. And so unfortunately, COVID-19 was kind of the trigger to into that correction territory. And in some commercial real estate asset classes, not surprisingly, hospitality as well as retail, the situation has become extremely dire and stressful. And I think the fallout we are going to see over the next quarters and years in that particular space. Multifamily, at least so far, has been doing extremely well. I would say primarily driven by the fact that people still need to have a roof over their home, right? So there is not really any change to that. And the stimulus money, as well as the bonus and employment checks, certainly have helped tremendously to keep these tenants in a situation where they were able to pay for their rents. Now with the stimulus money running out and unemployment still hovering somewhere near the 10% mark, I would say we probably will see more stress in the multifamily space than we have seen so far. And there is certainly some indication based on all the deals that we underwrite. We look at dozens of deals per week. And I would say over the last month or so, we certainly have seen many more deals that had a very strong performance all the way up to July and even August in some instances. But now we have seen that there was a drop-off in rent collections. And again, it's really a result, in my view, from the stimulus money that has run out with some people that they have used up, and also the bonus unemployment checks that now have shrunk or have gone away completely. So I would foresee that it's only tougher to keep these collections up. And that also now kind of shows to us, but based on all the deals that we see, the good operators to excellent operators that tend to do fine because they are ahead of the curve. They knew what was coming. They talked to their tenants. They gave them assistance, the resources to reach out to local support programs by cities and counties. And these operators tend to do pretty well, whereas the ones that have weak property management in place or self-managing and do not really have paid attention to all this, they are suffering more. So we clearly see a kind of a spread between the good to very good operators and the ones that kind of were okay to operate a property in the best of all times, but now we see that they obviously have some cracks in their operating modus. Right?
Mm-hmm. And I think that's a really key thing to point out. And that's the opportunity that we're seeing as operators, as syndicators, is that we're seeing those cases where there are people who have been self-managing, and they've been self-managing a property that's over 100 units. And so now it's tougher to do that. It's tougher, and so they're not able to keep collections up. They're a 1, 2, or 3 man show, and so they're eager to get rid of their properties. And so those that we're underwriting right now and those that we've been purchasing since March are in that category of self-owned, and now they're like, oh, this is too hard, I want to get out. So we're able to purchase them, put them under professional, strong property management, and turn them into cash flowing, high performing properties again. So I thank you for calling that out, because I think that's a really important point, and that's the opportunity in COVID. And with every crisis, there's an opportunity, right? And so, those people are getting relieved. Those people who are self-managing, it's a relief for them to no longer have this property that's very difficult for them. And then we're turning that into a cash flowing property for our investors and for our lenders, able to pay our debt to our lenders.
Yeah.
Yeah. Very cool. So for those of you, I see some questions about how this relates. So in the very beginning in my presentation, I talked about a syndication, and there was a pie chart. And so I said, there's a portion that we get from private lenders, that's the down payment. And then there's a portion we get from debt, commercial debt. And so that's where peak financing comes in. Someone like Anton would be someone I'd go to and say, hey, we have this property. We're underwriting it. What kind of terms do you have right now? Here's the project. And he'd look at it and say, oh, we could do this percent, we could do 3%, 3 years, no interest. He'd kind of give us those things that we could plug into our underwriting tool in order to determine how much we're going to offer for a property and what kind of returns we could get for our investors. So, his type of company and my type of company, we're like totally dependent on each other to make money, because we're joining finances, we're joining in on the projects together. So Anton, we have a huge mix in the audience. We have some entrepreneurs, we have some professional real estate investors, we have some people who are totally new to real estate investing. So I'd like to hear a little bit more on the markets that you're seeing. Are you looking for any particular markets right now? Like because you're still lending, right? You're still lending right now.
So certainly in the multifamily space, that's certainly the beauty about having access to agency debt that is readily available. And when you look back to the Great Recession, the fallout, that was really, they were for some time the only lenders that were really willing to lend at that point. And from March forward to maybe late April, it was essentially only the agencies that were willing to lend and some banks, right? But CMBS was completely dead, bridge loans were completely dead, and now it has opened up again. And I would say for the right property, for the right sponsor, you can go virtually everywhere in the country and you can get financing for it. Naturally, a lender will now have a much stronger focus on the market and the sub-market, right? When there are weakness in a particular market, then they will underwrite to that weakness that they see, right? And whether it's agencies or bank lenders or anyone else, we know the performance of other properties around the subject, right? So you have a situation like, I'm based in Dallas, but it doesn't really matter what market you're in. It can become hyper local when it comes to the underwriting. So you cannot just say, well, in Dallas, Fort Worth, it's fine. You can get that deal done without any problems at X amount of leverage. Because you have certain submarkets that have been performing really well, and others that we already have seen a significant drop-off over a broader portfolio. And the ones that have weaker performance, obviously, when you attempt to buy a deal in those markets, it doesn't mean that you cannot get the financing, but the underwriting definitely will be more conservative. And that is particularly important when we talk about interest only, right? In the past, interest only was very liberally given, I would say, to some extent, probably too liberal. That was possible because of the aggressive underwriting to a so-called exit test, which was driven primarily by the rent growth that one assumed, right? So if you assume a rent growth of 3%, obviously the valuation of that property on paper goes up significantly over the long term. And as such, being able to add additional years of interest only was much easier. Now, With COVID-19, that certainly has changed. Now, rent growth generally is being underwritten much more conservatively. However, even within a particular market, there will be submarkets where the underwriting will be a little bit more aggressive, and in some submarkets where the underwriting will be more conservative based on a portfolio's performance of existing properties and their loans that are out there. So you essentially have to, it's extremely important that before you submit an LOI, that you really understand what is truly available in terms of loan options for that particular property. Right? What is the mistakes that we see a lot, that someone has bought a property in the past in a particular market. They think that they know what the financing will look like today, underwrite to these assumptions, submit an LOI, and then they reach out to us and say, okay, so now we have accepted LOI, so now let's get deeper into the financing. And in some instances, we had to bring them down to the reality and communicate, look, yes, these assumptions were accurate until recently, but that's no longer the case. So that's why now more than ever, it's really important that you reach out early so that we can help you to really guide to what is possible and what is not.
Definitely. And yeah, so when we're underwriting, we definitely reach out first so that we don't underwrite with the wrong conditions and whatever information we get. So if you say, oh, it'll be 3%, we'll underwrite at 4.5% because just, by the time we close, it could be different in 2 months from now, right?
Yes, that's definitely the case. Right? You have some programs, obviously with banks it's a little bit different, but among the agency programs, one of the advantages is with Freddie SBL is that you have essentially the rate quasi-locked when you apply for that loan. So at least you have that protection there. And you also have the early rate lock options with the conventional loans on the Fannie and Freddie side. So I would say, particularly when you go into an uncertain time period, that probably makes sense to take advantage of that. But you just never know, right? The reality is, unlike on the residential side where you get personally approved, you get the rate approved, and then it all depends on appraisal, and you essentially know that you get that financing done very quickly at that rate. With commercial real estate, including multifamily, that's just not the case. There are so many items that are being looked at and that potentially can positively or negatively impact the loan proceeds and the loan terms, that you just need to have that cushion in your own underwriting. So that's the absolute right approach.
Yeah, thank you for that. So Anton, I think it's really encouraging to hear that you're still seeing opportunities, you're still seeing strength in a lot of markets across the US. You're still lending millions of dollars to syndicators because you see deals that have merit. You still see multifamily projects coming across your desk that are very strong. Your underwriting is a little different, but there's still a lot of opportunities even in COVID. So I appreciate you sharing that with us. And like I've been saying, there's always opportunity in every crisis. So I'd be curious, Anton, if you can share with the audience. So the title is Build Your Legacy, of this summit, Build Your Legacy. So how have you done this for yourself, and how has your company enabled other people to do this?
Yes, so I have been involved and investing in commercial real estate for now 30 years, right? So personally, I've been living and breathing commercial real estate, and particularly multifamily, for a very long time. We have never syndicated because that's not what our goal was. It's essentially family and friends, and we do it much more with a long-term goal.
Mhm.
So it's very different, obviously, from what you and many others are doing in the syndication space, where you reach out to passive investors and give them opportunity to invest passively in an opportunity they would not be able to do on their own. So we have taken that different approach. But I would say solely of all the real estate classes we have invested and we have experience in, multifamily certainly has been the most stable and consistent over a longer period of time, right? So there are some others that we have seen a massive uptick and a lot of profit over a very short period of time, but we also have seen them evaporate very quickly too, right? So I would say multifamily of all the commercial real estate space is, with a long-term view, it's only one that was the most attractive for us. Now, on the financing side, because of my knowledge in multifamily and commercial real estate, we are able to apply that knowledge that we have personally gained over the last few decades, also when it comes to advising our customers and clients on financing their commercial real estate and multifamily properties, right? So we think probably more than most as property owners when we look at deals. So we communicate here. It's what's available from a lending perspective, but we always highlight the risk reward element to a particular strategy someone brings to the table, right? So it's very different if it's a family that buys a property with a long-term hold, kind of legacy type of investing for the family and for their kids, versus someone like you who has a syndication in place that likely has an exit scenario somewhere around the 5-year mark. So the strategy that we propose is aligned to what you actually are planning to do with your group and your type of investment. And I would say that's probably the biggest value that we can add, other than just giving you truly realistic scenarios rather than just pie in the sky, just that we get you into the door and worry about the retrade later. But other than that, the realistic element, it's really that we highlight to you also the risks that you're taking and the rewards that you have with every single loan scenario.
Mm-hmm. Mm-hmm. Well, awesome. Thank you, Anton. Is there anything else for our audience? I mean, a lot of them, this is new space to them, but a lot of them are really excited about real estate. Is there anything that one last thing you'd like to share with the audience?
Yeah, I would say for obviously the ones that are already experienced, they are very familiar with the process for commercial real estate financing. I would say for someone who has been in real estate, but mostly in the single family space, be aware that it's a completely different world. It's much more of a team sport. You need to have your team together, whether it's from us on the financing side to the lawyers, to property management, construction management. It's so crucial to have a solid team in place before you start venturing out, because the last thing you want to do is make an offer and not having the team in place. The time will run out before you even know it.
Totally agree. Thank you. All right. Well, thank you, Anton. I appreciate you sharing your industry knowledge. Everyone, like I said, Anton's an expert. He's like his team, what did you say? 100 years of experience combined, and you guys are still lending in this market. You're still focusing and seeing opportunities where, your company's making money, the investors are making money. People are still finding good assets and finding good projects during this time. So I appreciate you sharing that message with the audience. And everyone, I will share how to get in touch with Anton, should you like, in the chat. And with that, Anton, thank you very much for being
Yeah,
here.
thank you very much, Sarah. It was a pleasure to be on.
Yes, thank you. All right. So up next, we have Karla Dennis. So Karla, if you're there, go ahead and jump on. Hey, how are you doing?
I'm good, Sarah. How you doing?
I'm doing great, thank you. Thanks for joining us again.
Oh, you're so welcome. Thanks for having me. I appreciate it.
Yeah, of course. So everyone, this is Karla Dennis. She has I don't want to downplay it, it's a tax company, but she does all kinds of things with tax. So she educates people on tax. So business tax, personal tax. Her company does taxes. She does tax strategy planning. I found her, just got on her email list a while back, and I was just so impressed with the amount of knowledge she has about the tax code, tax strategy that she pours out to her audience. And, it shifts the way you do things once you learn about tax. And so I think it's so important what you do, Karla. Obviously, you think it's very important too. So I appreciate you being here in order to talk to people about, what you do and how it can benefit all of us.
Absolutely. Whatever I can do to help bring value to others and teach them some nuggets, I'm all for it.
Yes, thank you. Well, you want to start by telling us a little bit about yourself and your company and how you got it started and what your expertise is.
Yes, absolutely. So again, Karla Dennis. My background is I started out in this industry working for a tax law firm, trained with some bright minds, got my undergrad degree in accounting, my master's in taxation. I'm a licensed enrolled agent. I'm not a CPA. I know sometimes people are like, what? You're not a CPA? I'm not. I am a true tax girl. Love what I do. I eat and sleep taxes. And my firm, Karla Dennis Associates, Inc., we help individuals reduce their tax bill, structure themselves to take advantage of investments that they want to get involved in, to save money, help build their wealth, to show them something different from just tax preparation. Do we prepare returns? Absolutely. But that is a byproduct of a much larger picture on the planning space.
Yes, thank you. So in the audience today, we have entrepreneurs, we have real estate investors, we have startup investors, we have, everyone is from a different stage in life. We have people who are mid-career, who are thinking about expanding their investment portfolio. We have people who are later in their career who are thinking about retiring soon. And so I'd love to hear from you, since you play a critical role for all these people in making decisions. What advice would you give to people as a first step in becoming really conscious about and intentional about tax and how it should be affecting all these decisions in their lives?
Yeah, absolutely. I think that one of the real first things that I would want to tell individuals is to really understand that taxes are such a big integral part of what I like to say money in motion, whether they are investing in real estate through single family they're going to own, whether they're investing self-directed, whether they are going to try to leave a W-2 or supplement W-2 income with passive income. Everything that we do, there's a component of tax to it. So understanding that on their team needs to be a tax person, and embracing that I got to look at these taxes even when I don't is real important.
Yeah. And so a lot of what I do is encouraging people to look at what the wealthy do in order to, even if it's on a different scale, in order to emulate it. And so what's one of the things that you see wealthy people do that you would suggest, everyone else do and emulate in the systems and their team around their finances?
A good questions, right? Emulate the wealthy. How did those people get wealthy, and how are they keeping their wealth, and how
Yeah.
are they not paying it over in tax? One thing that I would say that wealthy people do is that they understand that the tax code is set up to help the economy, right? To help cut costs and help spur the economy. So wealthy people plan not to pay income tax, or they plan to minimize taxation. It's not by happenstance. It's not, oh, so I didn't pay tax. It is done strategically on purpose.
Yeah, definitely. And how do you help people get more strategic about that?
Yeah, it's really about understanding what their goals are. And I like to use myself as an example. I live my life out loud, if you will. And I think
Mhm.
what it really is sitting down and saying to individuals, what are you trying to accomplish? And sometimes in the beginning, someone may say to me, oh, Karla, I just want to acquire another piece of property. But it's really a bigger conversation. It's really understanding their goals, looking down the street 3, 4, 5 years from now, and making certain that with those goals, we are wrapping a tax plan that is going to reduce their tax bill in alignment with what they do. But it has to start out with understanding their goals, really taking the time to talk to them, not just about looking at their numbers. It's really starting with the whole person. So it has to be a holistic approach.
Yeah. So going back to, we were talking at the beginning of the day with the audience about setting goals, and that's something that, when I started in real estate and studying real estate 7 years ago, um, I I had some vision, but it wasn't until I set really specific goals, with a date and a number.
Yes.
And that's when things started to materialize as far as, getting close to where I wanted to be. And then communicating at that time, it was communicating those goals with my spouse. Like, we need this passive income by this date, and then working backwards from there. And now we're working with you to see how we can get there even faster by not leaking
Right.
out money
Right.
in
It's a
taxes.
process.
Yeah. Mm-hmm. Yes, it is a process.
Yeah.
So go ahead.
It is a process. Like to your point, you said that you laid down some goals. So once you even put those goals down and say to yourself, okay, this is what I want to accomplish. I think that when people put goals down, they scare themselves a little bit because it starts to become more of a reality. And then they have to identify the gap, right? From where they are today and where they're trying to get to. There's always a gap analysis that needs to be had. And typically in that gap analysis, there's a dollar, right? A dollar associated with that gap. And
Mhm.
part of that dollar gap is, how do we take all the resources you currently have and squeeze them as tight as we can to generate as much income or cash on the table for you to get to your goals?
Yeah, awesome. Karla, do you mind if I just ask you a whole bunch of questions that people
Please.
always ask me? And I always say, you should talk to a tax professional about that. You should talk to a tax professional about that. So a lot of the audience, I was looking at least as far as who is saying hello in the beginning. A lot of them who I've seen leaving comments. So I know you guys, and some of these are questions that you guys have asked me around investing in syndications. And so I will just go ahead and ask you, since you're the tax expert, and then hopefully all those listening, this will be like a group answering of your question. Okay, so in the example that I showed earlier to the audience, I talked about an apartment syndication where there was an 8% cash on cash return and then a 20% annualized return. And so a lot of times people ask me, well, how is this taxed? And so there's the cash flow, and then there's the capital gains at the end. And then we give them a K1 that has depreciation and losses on that. And so I always say, well, we pass through depreciation and losses, so that can counteract income that you receive on this property. And so this is going to be a lot of questions wrapped in one. So first, let's talk about that 8% cash flow that comes in. Is it taxed in a special way? Is it taxed as normal income? How is income from an investment taxed?
Right. So the income and investment, if it's just coming in as straight income, it's typically going to be passive income if
Mhm.
it's coming in from a real estate deal. So it's going to be taxed just as passive income coming across the tax return. Really, though, if that deal is wrapped up in a venture that's coming across as a K1 at the end of the year, that's going to be their reportable document. I would imagine that they're going to have some rents coming in from their deal. They're going to have some depreciation coming in that's going to flow across. All of that ultimately will come on to their individual tax return. And one of the analogies I like to use, Sarah, is I tell individuals a K1 is to an investment as a W-2 is to your job. You get your income all year on your pay stub, but then you get your W-2 at the end of the year. When we get those K1s, that's when we know exactly how that income is going to show up on their return. Are they getting interest income because they're getting paid some return on their investment because they've helped fund the deal? Are they getting rents that are coming in because there was some net profit or loss on the deal? Is there depreciation because they're investing in real estate? So then that flows across. And then once those things flow across, how they're handled on their individual return then is predicated upon what's going on in their individual tax world. Many times clients will say to me, oh, I'm invested in this deal, but I'm not getting the benefit of it on my personal income tax return. That could be because on their personal return, they're not structured to get the benefit of it. So to answer your question, that K1 can produce a lot of different income streams, ordinary, passive, rents, capital losses, capital gains, depreciation. But at the end of the day, the way it flows and how their return is set will determine how they benefit or pay tax on it.
Yes, beautiful. So I see people asking some questions, and one of them is directly related to what you said. So you guys go ahead and type in the chat questions. That's great. So one of the questions is, how is depreciation passed to investors on syndication deals rather than directly owned real estate? So if you invest in an apartment syndication that I've put together, and have 5% ownership, we pass on 5% of depreciation and losses to you and that'll be in the K1.
Right. That'll
Yeah.
come across on the K1 form. We'll pick up their share of it and appropriately put it into their individual tax return.
Yes, beautiful. And then what about 5 years down the line when the property is sold? And so again, they're not on deed in an apartment syndication. Everyone, you would be owner in the LLC that holds the apartment syndication. So when the property is sold, you get your principal back, and then you get a lump sum for the appreciation that you've earned. And so, Karla, would you mind talking about this lump sum, this kind of capital gains? How does that work in this scenario?
Yeah, so when the deal is sold, their K1 will then show their share of the gain based on their amount of equity, their percentage of ownership in the deal. It's going to come across the K1. We're going to see ordinary income from the sale. We're going to see capital gains from the sale and or loss, depending on the deal, of course. Their pro rata share will show up, and then it gets appropriately put into their return. If it is a capital gain and it's a long-term gain, then they'll get taxed at the long-term capital gains rates. If it's short-term, they'll get taxed at the ordinary income tax rates. And typically, whomever handling the actual tax return for the syndication, they're going to do the calculation at the syndication level and prorate out to each investor, and then they will individually pick up their piece.
Yes, beautiful. Okay, so this was all a scenario where someone's investing in cash. So, excuse me, Sarah has 100,000. She invested in a syndication. That's how it would play out. Is it any different? And I think you alluded to this earlier. Is it any different if I invest with an LLC or a trust? So instead of the shares of the company, the shares of the apartment building being held in my name under my social security, I use the EIN of a trust or an LLC. Does that change anything tax-wise?
From the perspective of it will change, from the perspective of if they used an LLC to invest, then those proceeds are going to be issued back to the LLC. If the LLC is a single member or multi-member, it is going to eventually flow back to their individual return, just depending on how the LLC is set up. And most times in a situation like that, it's going to be set up as a flow through where they're going to get a K-1 from their LLC, which is going to flow back to their individual return.
Okay, beautiful. And will that change how much tax they have to pay?
No, that in itself will not change how much tax they have to pay. The LLCs, and again, I'm not an attorney, but typically are set up to provide them with that liability protection. And what they do inside of their LLC as individuals, owners of the LLC, their write-offs, of course, can help mitigate tax. But I think something that to be mindful of is in the aggregate, the individuals that are investing in their syndications, all of it is going to drop back to their individual tax return. So the key will be making sure that the individual tax return is prepared to catch the tax without dropping it so that Uncle Sam doesn't get ultimately that much of the money, right? There has to be planning at the individual level.
Okay, beautiful. That is like really a big question I get is, well, will I save money or will it change my taxes if I invest with an LLC or a trust? And so that's great. So it sounds like it changes things. It affects things. It affects how you invest, but it doesn't ultimately change the dollar amount of taxes that you have to pay.
No. I think the key for most individuals is to invest, right?
Mm-hmm.
Wherever you have the cash available to get into an investment, I think it's always important from a wealth building perspective to get into the investment, whether you are investing using self-directed funds, where you're investing with cash, whether you are 1031, however you get into the investment, always go for the cash, go for the investment. But at the end of the day, you got to plan to receive your return on investment and plan that out correctly. I get often people asking me, oh, I'm going to go into this syndication and they are setting it up like this. Is that going to be good for me? Is that not going to be good for me? Well, really, the question is the cash flow and the investment good for you? The way that they're doing it is based on how they do it, what their revenue model is. Our role in that is purely to make sure from a tax perspective, you're able to keep your return on your investment. You're able to keep those dollars and parlay them into other investments. So sometimes I think these type of education platforms that you're doing are so incredibly helpful because it makes individuals really see that you have to have a team. You, Sarah, are good at what you do on the syndication side. Your job is to help them make that money, right? That's your goal. But the tax side is a completely different animal.
Yep, not my wheelhouse. Yes, and that's a beautiful point that you need all pieces of the ecosystem if you're going to be serious about wealth building so that you can make the appropriate decisions.
That's right.
So
I like that, the ecosystem.
Yes.
That's right.
Yes, definitely. I'm not doing this alone. I have you
No.
talking to me about my taxes. I have an attorney talking to me about legal stuff. I have the coach teaching me about online marketing. You know, you got to have your ecosystem of support. If you try to be a one-man show, no one makes it very far on their own, do they?
No, they do not. And there is not one person that has the answer to all of a person's questions. I
Right.
think that's something else that people assume that, oh, if I go to this individual, they're going to have 100% of the answer. I am really good at saying, let me tell you what I don't know. This is what I don't know. And these are the people that I trust are going to know or point you in the right direction.
Mm-hmm. All right. So then the last vehicle that I talked about when I gave my presentation earlier about, you know, how you can invest. So in an apartment syndication, I said you can invest cash in your name. You can invest with an LLC or a trust or an entity, which we talked about. And then you can invest with your retirement fund. So your self-directed IRA or your solo 401k. So I see a lot of questions in the chat related to this. So if you invest with self-directed IRA or solo 401k funds, all the returns that you receive from the syndication investment need to go back into that retirement account. Is that correct?
That is absolutely correct. And that's a question I get often too, is that if I invest, how do I get access to my money? So it really comes back to the principle as to where did you get the money to invest? If it was from what we call qualified funds that have not been taxed, in order to access those funds, there's going to be tax. That's just straight tax law, nothing that we can do about that. So the money that you're using from your self-directed funds, they have to go back into that retirement account, or that becomes a completely different issue. With the same premise, though, those types of syndications are also going to issue K1s to those accounts as well. And many times we will receive those K1s and clients assume that that should show up as taxable on their return. But it will not, because again, that's what qualified money, there is no tax event yet until you actually start to pull your retirement from your qualified dollars.
Yeah, perfect. Thank you for that. So do you mind if I just read out some of the questions? Because I don't think you're going to be able to be here for the Q&A, right?
Right, I will not,
Okay.
unfortunately.
Okay, cool. Well, let's read through the questions then. All right. So Dave, we're going to start with your question. If we invest in a syndication in our self-directed IRA, are we able to use the benefit of depreciation at all?
No. If you're investing in your self-directed IRA, you're not going to be able to utilize the benefit of depreciation on your personal returns.
All right, thank you. Then MacArthur, hi. You say, when you say that you're not getting a benefit personally from the K1 investment, what did you mean about not being set up properly? Sorry, MacArthur, I'm not sure which, if you type it again, I'm not sure which comment you were talking about. Does that ring a bell for you?
That does ring a
Oh,
bell
okay, go
for
it then.
me. So
Okay.
what I think that individual is speaking of, let's say that you're in a syndication, and one of the things that we may be getting return on investment, some interest, but we also may be passing through some real estate rents, and we may be passing through some depreciation, right? But maybe that individual's tax return, they could be in an income that precludes them from being able to take any of their rental losses. Maybe they are not, their income level is too high. Perhaps they're over, and they probably would be over 150,000 in adjusted gross income on their return. Therefore, if they are not set up properly and structured properly on their individual returns, they're not going to be able to benefit from one of the greatest deductions we have is depreciation when it comes to real estate. I literally yesterday was dealing with a client who is in that exact scenario, and a great investment, some great depreciation coming across. but they were not able to take advantage of it because they did not sit down and do any planning prior to. What I will say to that, though, let's not lose sight of why we're in the investment. Typically, we should be investing to get a return on an investment. That's the reason we should be investing. The tax benefits are a side item that we need to look at, but I don't necessarily personally am going to make a decision on an investment purely because of tax benefits. I'm looking for return on investment. That hasn't changed. Can I structure and get great tax benefits? Probably. But I think that that planning has to be there to be assured that you could get those benefits.
Mm-hmm. Beautiful. Another one, this is from Kay Powell. It's along the same line. Why would you put real estate in an IRA and lose tax benefits, including depreciation losses, etc.? And I think that you just answered it. I'll give my answer and then hear yours. That depends on, if you have money in a self-directed IRA and it's performing at 5%, and you see an investment that's going to perform at 15%, then move your money into the better investment if you think, it's legitimately a 15% return on your investment. So that's why you would put real estate in an IRA, is if, like Karla said, if you're looking at the highest return on investment that you can get.
Yeah, and also maybe your money is in a 401k, maybe your money is deferred and you do not want to take the tax hit by pulling your money out, getting hit with tax. Maybe you're not 59 and a half yet, so you don't want to be penalized on pulling that money out. So you're going to make a decision to invest self-directed, which I think in the right situation is a beautiful thing, to go self-directed, allow your money to play a bigger game for you, to be in real estate, not take the tax hit, get your retirement zooming, right? Just growing. It's for the right person with the right strategy.
Yes, definitely. All right, so Joe and Alice, I think you guys have really similar questions. So let's see. If the multifamily investment was funded from a 401k, doesn't the income go back to the 401k and not taxed until taking distributions?
That is correct. The money goes back to the 401k and not taxed until there are distributions. That is kudos to that individual.
Good job, Joe. And Alice saying that could be a huge chunk of taxes if you invest with cash versus using a solo 401k. And I would say, yeah, I'm rolling a 401k into a solo 401k so that I can invest so that it's, tax deferred, and then you can be earning money on your taxes for the time. You can be earning money on those returns instead of paying them out in taxes for the time being.
Right.
So.
Right. And something else, Sarah, to also keep in mind is, I know individuals ask this question often. If I'm investing through my retirement account, I'm doing self-directed, and I'm in a great deal or whatever the case may be, I'm going to have big taxes later on down the road. Again, it's about tax planning at every juncture when that money moves. When you're ready to take distributions, you need to have a tax plan in place to just mitigate the tax. But I don't think worrying about the taxes down the road should prevent you from investing today. If you only have qualified money to invest with, then don't stay out of the market because you're worried about taxes tomorrow.
Yes, which is interesting. I did have an investor who had money in their solo 401k that was sitting in cash, but they didn't end up investing because they were worried about UBIT tax. And I said, well, your return minus UBIT is still going to be higher than no return if the money's sitting on cash. So yeah. I 100% agree. don't not invest because you're going to get taxed on your returns, because no matter what you invest in, even if you invest in stocks, you have to pay tax on the returns from your stocks as well.
Yeah, but I think that people look at UBIT as a crime against the government, if I could say that. It's just a thing that just makes people extremely nervous. I think, to your point, and a very valid one, is you got to look at the big picture. You got to look at the cost of acquiring the money, the utilization of the funds versus your return on your investment, and just do a cost benefit analysis and make a strategic decision. Because at the end of the day, you want to be in the plus column. So if having to pay some UBIT, having to pay some income tax is going to get you invested in the market and get you a big return on the investment down the road, then it's probably the better play once everybody's looked at those numbers and analyzed it for you.
Yeah, definitely. So Alice, I see your question. Yeah, UBIT using self-directed IRA. So you do have to pay UBIT if you're using a self-directed IRA to invest in a syndication, if it's leveraged, which they almost always are. But you don't need to pay UBIT if you invest with a solo 401k in a syndication, the way that we've structured it. All right, so I have one more, Karla, that is, because I know you have to jump off. It's super important though. This is from Kathy. Thank you, Kathy. What do you ask a potential tax professional regarding syndication investments to ensure that they know what to do and how to do it? And this is really key, because a lot of people who are investing with me, when they ask me tax questions, and I say, ask the person who helps you with your taxes, a lot of people come back and say they've never heard of this. They don't know what to do with it. So what questions could people ask a tax professional in order to know if they're the right person to help them?
I think that, what does a tax professional talk about? What is their area of a specialty, right? People lead with what they know. I don't think it's having to really figure it out. It's almost like I need to look for somebody who specializes in this item. And I think it's important to realize that the tax code is a lot in the tax code. And real estate is an area of specialty. I think that you should ask them, what type of clientele do they have? What's their favorite part of the tax code? Not tax preparation, but tax code, tax law. I think that I like to do business with people who do what I do, right? So if I'm going to work with people, I like those people to sort of mirror me and the things that I'm trying to accomplish. If I am trying to, for example, move to a house on the beach in a hill, I may not necessarily talk to a real estate agent who's never sold a house on the hill near the beach.
Yeah.
It just has to be people that are in that circle and understand. If you find yourself having to explain too many things to them, they probably don't know. And it's okay that they don't know, but you have to ask yourself, do you want to be the guinea pig? Right? Because somebody is going to learn at somebody's cost. I just think the questions become, who are your clientele? Are you a real estate investor yourself? Do you enjoy real estate? Do you have clients that are in this market? Every tax person may not be invested in real estate, and they may know about real estate. Do you have clients in this marketplace? Have you ever dealt with an audit in this area? I think that's a great question to ask. It's one thing to put together a return, something else to structure it, something else to be able to defend it. I think those are just some great questions, and ask around. People will know who in the industry knows the industry.
Mm-hmm. And so I know some of Karla's answers to the questions that she just said to ask. Karla is a real estate investor. She does have a lot of clients who are real estate investors, and she is really well known in the industry. So I'll let you know that those are some things about her that could make her a good person to chat with. Awesome. Well, Karla, I know you have a hard stop right now, so I want to say thank you so much for answering all those questions. And there are tons of questions in the chat for you. So popular topic, taxes.
Well,
Very
I just want to
important.
say, thank you for having me. I'm honored to be among the people that speak. I just always am humbled to be able to provide knowledge. And at the end of the day, you know, my philosophy, it's like go out and make as much money as you possibly can. Taxes are always going to be here. Our goal is not to overpay them and to utilize the tax code to minimize them. Just stay within the law and we'll all be fine.
Yes, beautiful. Thank you so much, Karla. And audience, I'm sure that we'll see Karla again. We love having her on. So thank you so much for your generosity and your knowledge and wisdom, Karla.
You're welcome. Have a great day.
Thanks. Bye-bye. All right, audience, stand up, move around. We have one more speaker before we jump into the Q&A, and that is Kaaren. Kaaren, are you here?
I'm right here. How are you?
I'm very good, thank you.
See if we can get a little light here.
All right.
Right. And is
All
that enough?
right.
Hopefully you
if
can see me.
I can
Give me
see
one
you.
quick second. I'm going to fix that PDQ.
Okay, cool. I will go ahead and introduce Kaaren. So we've been talking about self-directed IRAs and solo 401ks. If this is a new term to you, Karen's going to give a presentation about what these accounts are, how do you use them, how do you create them, and yeah, so she is the CEO and founder of UDirect IRA Services, and they're 11 years old. Is that correct?
Yes.
You've been in
Yeah,
business
11 years old. That's right.
Mm-hmm. So I am excited because people always ask me tons of questions. They ask me tons of questions about tax, and then they ask me tons of questions about, oh, is it better for me to invest with my self-directed IRA and my solo 401k, and what accounts can I roll into what? Can I use this account and put it in a self-directed? What are the rules around opening a solo? And I answer them to the best of my knowledge, but I always say, ask someone like Kaaren, who is the CEO of a company that does that.
You know, I just loved hearing Karla talk about, you know, obviously she's brilliant, and it's wonderful to hear her talk about UBIT and UDFI and the taxes, because everything she said was so right on, and I get asked those questions a lot. And when they go deep, I always say, talk to a competent tax professional that understands this. And now we all know another one, don't we? So we know,
Yes.
now we all know Karla. So that was fantastic to hear what she had to say. So
Yeah, thank you.
yeah, you know, with self-directed IRAs, I've got a lot I could say. I'm certainly interested in what people's questions are. But I think I would start off by saying that self-directed IRAs are all about later. You know, they're not about having money today. Some of the other speakers are talking about the CARES Act. And yes, it's true, the CARES Act has allowed you until December 31st of this year to take money out of your retirement account if it's COVID related. If it's a 401k, you pay that money back. You can take out more than you usually could. If it's an IRA, you can take out that money penalty free, but you're still going to pay tax on it over a 3-year period. Now, since I was hearing the other speakers talk about it, I thought I'd kind of bring it up front. And yes, those are things you can do. I'm more conservative, I think, than some of our other speakers. And I say, if the money's in your retirement, grow it in your retirement account, grow it in your retirement account, because it's just so hard to replace that money. You know, you've got contribution limits. So maybe you take out $100,000 from your IRA, but good luck putting it back. I mean, it'll take you, 15, 20 years to get that money back in there. So if it's in an IRA already, why not leave it there and invest tax-free with a Roth or tax-deferred, right? So that's my stance on it. But these COVID, the CRD, the coronavirus related distribution, you can read more about it. It's also on our website at udirectira.com. So the CRD is something you can do, you can research it, but I say, hey, you know, use that money in self-direct. It's really, really for later. And guess what? Later, you're really, really going to need it. And that's what self-directed IRAs are about. They're about taking your qualified money, maybe it was from like a 403B, 401k, 457, and rolling that over into a self-directed IRA to invest outside of the stock market, like so many of our speakers have talked about this morning. And that's what we help you do. So again, about saving for retirement, if you say, like, we're going to use a little numbers here, okay?
Perfect.
So if you're 59 and a half and you know you're going to live until you're 86 and a half, And so you want to take an even distribution every year. So now you're going to retire, you got $100,000 every month, you're going to take an even distribution. So assuming no gain or loss, that only gives you like under $400 a month to live on. So if you think, wow, $100,000 is a lot of money, it is. I mean, I'm not going to say it isn't, but you need to grow your retirement account. That's what I'm saying. You got to grow that thing. And all of our speakers have talked about ways and strategies, but keep listening to these kinds of brilliant podcasts like Sarah has put together today, where you can just really learn and start to form your own kind of methodology, your own structure, and what's good for you. You know what I mean? As far as investing goes, and start building that retirement account. I love what Karla said, if you've got a big 401k, are you going to put it in the stock market, or are you going to pump it into real estate or some other asset class that you understand? And these give you the freedom, okay? So one takeaway from my chat here today is to make sure that you contribute to your retirement account. Could be a 401k where you work, maybe your employer matches, maybe that's free money. That would, it can be. So contribute and save for your future as much as you possibly can. All right, so self-directing that money. We'll talk about it. So first off, when people say, oh, Kaaren, I see on your on your website that it says a SEP IRA, but I need a self-directed IRA. And that is a super common mistake. So just understand that an IRA is an IRA. I mean, an IRA is a bucket that holds assets, right? So all of them can be self-directed. So a SEP IRA can invest in the stock market, or what makes it self-directed is that it's truly self-directed, is that it's investing outside of the stock market into alternative assets. So the term self-directed IRA typically infers that you are investing in alternative assets, but all the rules are the same. So you go to the IRS's website, maybe look up publication 560 and find out all the rules about SEP IRAs. Great. That applies to self-directed IRAs as well. So as we'll go through, that's the traditional, the Roth, the SEP, the simple, even a spousal IRA, inherited, and a solo 401k. All of them, we provide all of these accounts, and they can all be invested, in assets that you know best, right? And so that's what we're here to help you with. There's just so many things to talk about with, regarding this. So we've talked about the difference and all this. And I think another thing too is when you hear about assets that you'd like to invest in, you think, wow, this is great. I really think this is a good idea. I would like to put this asset in my self-directed IRA. But you're working at a company, and that company offers a plan, and you're thinking of using that money. Little hitch, maybe we can help you get around it. But if you're in a 401k, 403b, 457 with your current employer, you might not be able to move that money over. That's important to know. So what you can do if you have a 401k is you can go to your plan administrator and say, hey, I've got this money. It's in this plan, this 401k plan. Can I get what's called an in-service transfer? Can I move that money from where it is now into an IRA? And they'll tell you yes or no based on the rules of the plan document. It's not IRS rules. It's like contract law. It's in the contract, the plan document. If you can move the money, then yay, you can, but a lot of times you can't. Sometimes when you can, some of the conditions will be maybe you hit 59 and a half. That could be a condition that allows you now to take an in-service transfer. Maybe you worked at company A and they were purchased by company B, and maybe you can move the money over from company A and move that over. So that's another thing to consider. All right.
Oh, that's a question that I had, because my startup that I work at was just purchased by another company. And so, yeah, there's a pool of people. And so once it's purchased, then the 401k from the original company, you could move that into a self-directed, right?
Well, you might be able to, yeah. So you look at the plan document and see if it allows it. And so you just ask the plan administrator. Yeah, that's great. Because how many people right now are changing jobs too? That's another thing.
Oh, yeah.
Lots of people are changing jobs. A lot of people have 401k money sitting there. I mean, this week, as one of our earlier speakers pointed out, it's been a roller coaster this week. And often it is. It goes up and down. And do you want it in the market, at risk in the market, or do you want it, I mean, like all investments have risk, or do you want it in different assets like real estate or precious metals or notes or things like that. So yeah, but check with your plan administrator on that one to see if that'll go forward.
Okay.
And before you self-direct, we've talked a lot about today about, investment safety and so forth, but doing due diligence is so crucial before you start, self-directing. And on our website, we have information if you're investing with a secured asset, like a registered asset, like a note or a private placement, like crowdfunding. There are sites where you can go and check on the asset sponsors to see if they're what we call bad actors. Lots of air quotes here today. See if they're bad actors. But like the SEC has a website, FINRA, there's NASA with an extra A, NASA, even AARP. You can go on their websites and check out registered advisors and registered investments, which would be a syndication, a Reg A, B, C, or D offering. You can check out the offering, you can check out the sponsors and see if they have, hey, what if they had a criminal record? You'd want to know that, right?
Yeah.
So do your due diligence and check them out. If you're investing in real estate, you want to do your due diligence before you take this precious retirement money, because you've got caps on how much you can put in these accounts. You can't just decide one day to put in a lot of money. You've got caps. If it's a traditional or Roth IRA, right now that cap is $6,000 if you're under 50, $7,000 if you're 50 plus. So you can't just stick a lot of money in there. So do your due diligence. And when it's real estate, you want to maybe do a title report, get a preliminary title report, talk to a realtor. Maybe they have access to one of those services, like I think it was called Night Owl, or where you can, look up a preliminary title report and see who actually owns the property you're about to purchase. Does the person you're buying it from have the right to sell it? These are simple due diligence things that you want to implement. And what were you say? What did you call, Sarah, your nest of advisors? What did you call them?
Ecosystem.
Ecosystem. I love it. Got to have an ecosystem of great advisors. I love that. So, because if your self-directed IRA loses money, and Karla can confirm this, you don't get to take a deduction for your loss in your self-directed IRA. It's just gone. Anybody who lost money in the stock market during the last downturn, the Great Recession there, you didn't get to write off your stock market losses either if they're in a retirement account. So again, due diligence is just super critical when you're getting into this self-directed IRA space, so that you play to win. I mean, that's the whole thing. And we want you to win. Believe me, that's what we do all day long, is talk to people. Tell us, what are you investing in? What are your goals? What are you trying to do? And we're listening on the phone to think, well, is this a prohibited transaction? So let's get into that, because if you're going to play a game, you want to play to win, and you need to know the rules, right? So one of the rule books is on the IRS's website. It's irs.gov. Gotta love it. Publication 590, Pub 590, has all the rules for IRAs. Again, an IRA is an IRA, right? So Pub 590A talks about getting the money into the account. Pub 590B talks about getting the money out. It also talks a little bit about these prohibited transactions that I'm going to go over here in a minute. So it's actually light reading. You'd be surprised how understandable these publications are. But if you want to get really deep into the woods, where you're going to learn about prohibited transactions is the Internal Revenue Code. Prohibited transactions in the Internal Revenue Code 4975. Not so light reading, but that's where you're going to find it. If you can't go to sleep one night, right? I'll pull up the Internal Revenue Code and just read it. But 4975 is where you can read all about prohibited transactions. And if the people who are on your event here today, Sarah, these are intelligent people. You're intelligent people. You are right there, you. And I know that you know a lot about investing already, or you just wouldn't even be interested in this. So if you'd like to hear the rule book, that's where you can find it. Okay, so IRAs. So that's one thing. But when it comes to self-directed IRAs, there are some special rules. Okay, and again, play to win. So who are the players? We'll start off by who are not the players, who can't play the game. They're called disallowed or disqualified people. And those people are your lineal ascendants or descendants, and you and your spouse. So it's parents and grandparents, You and your spouse, kids, grandkids, right, disallowed to your IRA. Also, a 50-50 business partner, anyone who is a fiduciary to the plan is disallowed to the IRA. And that just means they can't play the game with you. All right. So, but the people who are allowed, the people who can play the game with you are out to the sides on your family tree, like your aunts and uncles, your cousins, brothers and sisters, nieces and nephews. They can all play the game. All right. So now you know who can play. You got to keep things arm's length. Just remember that when you're investing or planning to invest, just remember what you want to do is keep things arm's length. So the game of self-directed IRAs, keep away from prohibited transactions. And why? Well, when your IRA commits a prohibited transaction, or when you commit one within the IRA, and the IRS finds out about it, it just blows up the IRA. It blows up this protected tax bubble that you have. And suddenly all that money becomes taxable to you, and you'll get a 1099, and you may have penalties if you break the rules. So don't do that, because it can be very, very costly. For example, if you have, say, a $500,000 IRA, I hope you do, and you've got a $10,000 asset that turns out to be prohibited, it's not just that $10,000 that's going to be blown up and dispersed to you, it's the whole account.
Oof.
Will cease to have that tax protection. Okay, so that's what we're going to keep away from. So the way to do that is to realize, number one, that prohibited transactions would be, let's put it this way, neither you nor any of these other people can have personal benefit from the IRA. Present benefit, personal benefit, indirect benefit. You don't get to benefit today from the IRA. It's about later, right? So, yeah. So keep that in mind. So what that means is your IRA isn't going to lend money to your spouse so they can start a business. That would be a disallowed person receiving personal benefit. Another thing, I'd love to tell the story about when I very first opened the company 11 years ago, an appraiser had just lost his job, and he was going to go work for another company, had this 401k, he rolled it over, and he wanted to invest. I said, well, what do you want to invest in? And he said, well, a note. He was so excited. And I said, well, okay, well, who's the borrower? And he says, oh, well, my sister-in-law. I thought, well, that's great. Sister-in-law is allowed. They're out to the side on the family tree. That's okay. But I thought I should ask another question. You just have to ask the question behind the question. So I said, when your sister-in-law gets that money, what's she going to do with it? And he says, oh, she's going to invest in my company. Oh, he was so excited. It's just, but that would be so that would be receiving personal benefit from your own IRA, even though it went through a third party. That's indirect benefit, you see. So you can't do that. Smart investors say, well, what if I put it in my LLC and then my S Corp and sell it to my nephew? And then, don't mess around, because the minute the IRS goes looking down the paper trail, they're going to find out what it is. And, again, you don't want to do that to yourself. So I'm conservative, and I'm going to tell you the rules. So follow the rules, okay? Another rule with prohibited transactions, another keep away, is that you don't buy, sell, or exchange assets between the plan and a disallowed person. So your IRA won't buy a house that your father owns. An IRA won't sell a house to your children, that sort of thing. So you don't exchange, but you can transfer upon death. That is allowed. Those are your beneficiaries, and you always want to name your beneficiaries when you open the account. That's okay. But again, one of the areas where people really get caught up is in this one, where a disallowed person can't provide goods, services, or facilities to the plan. And that's exactly how it's written in the Internal Revenue Code 4975. So what that means, an example, we had somebody who was buying real estate with their IRA. Awesome. A lot of people do that. So we were looking through the documentation, and we could see, wait a minute, this person's last name is this, and it looks like the broker's has the same last name. So we called them up and said, hey, we noticed you and the broker have the same last name. Oh yeah, that's my dad. Well, two things here. The dad can't offer the services even for free, okay? It's called, you'll love this, an over-contribution of sweat equity. So even for free, dad couldn't do that, but dad also wanted a commission, which is provided, which is a disallowed person receiving benefit. So you may not realize what's a disallowed or prohibited transaction. And that's why when you call us, we're going to talk with you, and we're going to, how did you hear about it? We're going to ask you questions, how did you hear about us? But we're really going to want to know, tell us about your deal. Who are the parties? you know, and we're going to ask you about that deal. So we can listen to hear if we hear a prohibited transaction, so that maybe we can steer you in the right direction and maybe suggest you get more advice before you move forward. Because it's a pretty big deal. It's a pretty big deal. You don't want to commit a prohibited transaction. All right.
Yeah, I think it's unfortunate because, for instance, my father, every time I see him, he says, "What's your next deal? I want to invest with my IRA." And every time I say, "I'm sorry, Dad, you can't. It's prohibited."
Yeah.
And a lot of people ask me, as one of the sponsors, GP, you know, who are you investing your own money? And a lot of my money is I'm using my solo 401k to invest, and I can't invest in my own. I can only invest in my own with cash. So there's all these catches that I would love to have my family members be able to invest in my opportunities. But yeah, like you said, it's prohibited.
It is, and it just doesn't seem to really make sense because we don't hear that rule anywhere else really, but it is absolutely true with self-directed IRAs.
Yeah,
you know?
yeah.
So if you know the rules, win the game, right? And so I think it's also important to talk about who are the players, you know, so now the rules, who can play the game. We know, you know, disallow people can't, and you have to keep it arm's length, but understand there's you. You are the one driving the bus. You, the self-directed IRA holder, maybe you've got a solo K, you know, like Sarah does. But then there's your plan. So you are making the decisions for the plan, and the plan itself is an entity. So the plan can be the IRA, the 401k, just another name for it, another thing to call it. So you are making the decisions for your plan, but your plan is doing the investing. And then there's UDirect IRA Services, the best company in the world. Okay, I'm just saying.
Just saying.
Yeah. But we are here to help you from soup to nuts. You know, open your account. What questions do you have? How do you do this? How do you do that? I need some help doing this. We're here and your point of contact for everything. And when I founded the company in 2009, I solicited the services of a trust company custodian, and they hold the funds and they do the cash management and all those things. But we take care of you, you know, the self-directed IRA holder. So there's that. So those are the players in the game. So we could go deep on buying real estate with an IRA. I think that is something that is definitely of interest to a lot of people.
Yes, definitely. And I'd like to, because I missed this in your introduction, Kaaren, that you have a strong real estate stance, and tell people just so they kind of know your level of credibility on real estate about the chapters that you read.
Sure. So I personally, I was a realtor for a year, and then, which is enough to get a taste of it, but I was also a property manager for a few years in Seattle, managed like 3 or 4 buildings, and even had to evict someone, the whole thing, you know, so property management. And then I got into mortgage loan servicing. This is years ago, and was in that for a long time, which really taught me, we called it cleaning up after the elephant, after the mortgage was made, like how do you fix it? Self-directed IRAs are a lot like that, believe it or not. And then I got into mortgage loan origination and did that for quite a number of years, and help people, you know, mortgage their, it was in residential lending. And then in 2007, got into the self-directed IRA space. So ever since then, I worked for a competitor and then launched out and opened my own company in 2009. But along with having UDirect IRA Services, I also own OC RIA. I told my sister, I've got OC RIA tonight. She goes, "Oh, do you need some Imodium?"
Oh gosh.
No, I'm healthy. I'm good. But understand that in every major metropolitan area, there is a RIA, Real Estate Investors Association. Okay, so OC for Orange County. So Orange County Real Estate Investors Association. And we've been going strong since 2012. So coming up on, wow, you know, 8 years, wow. And every month we bring you a different aspect of real estate investing. We're having a meeting coming up on October 8th. With Sean O'Toole and Aaron Norris of Property Radar. But every month we talk about some aspect of real estate, but we don't sell anything. So there's just, real estate is everywhere, right? You can barely walk 2 feet without bumping into real estate. So it's important to really understand it. And so we help people do that. We don't sell anything at OC RIA. We're just there to teach. Okay, a little commercial for that. But let's talk about real estate and IRAs. Let's do it. Pros and cons. And you know, Karla was talking about this. She was saying, you know, should you invest in real estate? And the question was like, well, you know, you're not going to get all the tax benefits if you invest in your IRA, you know, with your self-directed account. And yeah, maybe that's true. You're going to get the advantages that you get from a retirement account, which is tax-free, tax-deferred investing. But you're right, you don't get to write off depreciation, you don't get to write off losses. So there are two questions. One is like, you've got a lot of money and you've got a retirement account, and which one should I use? That's one question. You call Karla or another tax advisor, and you say, hey, look, which should I do? Where do I get the most bang for my buck? And they might say, well, invest personally, so you need to ask. Like, yep. Didn't you say begin with the end in mind? I heard you say that earlier. Stephen Covey, I love that one. So do that and ask. But if you don't have a lot of money personally and you find a great deal and you have a retirement account and you can use that, well, use it. Because then it's a question of, should I invest in the stock market, Main Street or Wall Street, right? And, Main Street can bring you a lot of returns. So maybe that's what you want to do. Capital gains, any gain is tax-free, at least, or tax-deferred, tax-free in a Roth, tax-free for life, but tax-deferred in a different kind of account. But my favorite plus side of investing in real estate with a self-directed IRA is that when you sell the property or have any kind of liquidity event or anything, that money comes back in your retirement account, not diminished by tax. So 100% of it can go back out into your next deal. And so you compound faster. I think that's really the big strength.
Yes.
But to be fair, there's a downside. And I think the downside is, again, that we've covered. Of course, you're solely responsible for the gains and losses in a self-directed IRA because it's self-directed. You're the one choosing the asset. We don't sell assets. We don't recommend that you invest in any particular asset class. You were choosing your asset, so you are also responsible for the gains and losses. You can't replace that money easily. You can't write off a loss. So there are definitely things you need to know on both sides of the fence, pros and cons. So I think that's only fair.
Mm-hmm. Yes. So Kaaren, I'm looking in the chat and I see a bunch of questions about how does it actually work? Like some people are saying that they have IRA accounts or they might have a self-directed account with Merrill Lynch, but they can't do this. So how do they actually move money from where it is to somewhere that it can be self-directed?
Yeah, what a great question. I mean, it's funny because after self-directed IRAs got really popular around 2009, then all the brokerage houses got on board and said, oh, well, you can self-direct your account with us. And that's true. I mean, you can choose any mutual fund or index fund that you want. You can do that and self-direct, but to truly self-direct, what you would do is called a transfer. So you would open an account, takes, just a little bit of time to complete an application. So you get your account open, takes a day at the most, right? Then you complete our transfer form, you sign it, you give it to us and we sign it. We send it to your current custodian, and then they move the money over into your self-directed IRA account. That's how it works. Maximum 2 weeks. That's usually it's a lot sooner, but I mean, just, under promise, over deliver, right? So plan on 2 weeks at the outside. If you're moving an employer plan, it's a little bit different process. Then you open a self-directed IRA first, contact your plan administrator, tell them that you have an IRA, give them the all the information like the account number and the address and everything, but you fill out their forms and then they send the money over. So a little bit different with a rollover than a transfer. Or you could contribute. That's how you get the money in. So it would be like, write a check. It depends upon your age, your account type, and your income, how much you can contribute. Another good time to call your tax advisor and ask them.
Yes. Cool. So there's also Chris Kirkpatrick. He has an audience of entrepreneurs who are here. And so, and then I see some of my investors also asking about solo 401ks. So if someone wants to open one, can you kind of dig into what is a solo 401k? What are the rules around opening it? And how someone might do that?
Okay.
And then also, like, if you fold your company, if you have your own LLC and then you fold it, do you have to also fold that solo 401k? All right, take it away.
We'll answer that question first. You don't have to fold your solo 401k, you just can't contribute to it anymore.
Cool.
You still have to.
Okay, awesome.
Usually people will, though. They usually will dissolve their retirement plan at that point, but you don't have to.
Okay. Awesome.
You just can't contribute. So with the solo 401k, you think of there are two different worlds really with the IRS. There's IRA world and a qualified plan world, and the solo K is in the middle because it's a qualified plan for just one person with no full-time employees. So we'll start there. If you are an entrepreneur, you have a business, and you have no full-time employees in any of the companies you own, because entrepreneurs, you don't just open one company. Usually you're a serial entrepreneur and you end up opening a bunch of them. So if you have even one full-time employee in any of those companies, you don't qualify for the solo 401k. All right, so that's good to know.
Yeah.
Yeah. You can have part-time employees. It's 1,100 hours a year they're allowed to work. So again, tax advice, that's a good idea. And you always want your tax person, as part of your ecosystem. You want your tax person involved, especially because they're the ones that are going to be writing off the tax benefits on your return, right? So you want them involved.
Mm-hmm.
So again, the solo K is two parts. So it's the employer and the employee, the plan and the participant. We refer to these as both things. So the employer portion is larger. The employee portion has limits. So today, the employee portion, if you're under 50, is limited to $19,500 that you can put in per year as an employee or as a participant. If you're over 50, you get a catch-up contribution, and now it's $26,000. Boom, something like celebrate your 50th birthday, because now you can contribute more if that's you. So that's good. So about contributions, you can put a lot more in. But for a solo K, the maximum overall overarching contribution is 25% of your income, the lesser of 25% of your income, or $57,000. And your tax person is going to calculate that for you. And that's what you want, because you want to get the deductions and you want to make sure you do it right. And there you go. So they're going to calculate it for you. Hey, by the way, something really cool about solo Ks that just happened this year. Every year there would be this mad rush in December. Oh, I've got to get my account open, because you want to, say, for example, in 2021, make a previous tax year contribution, right? So up until this year, you had to get it done, and you had to have your plan adopted by December 31st. Well, boom, that's off the table now. Thank goodness. Now you've got up until your tax filing date, including extensions. So you don't have the December 31st crunch anymore. And again, this is why you bring your tax advisor along for the ride and tell them what your plan is and have them make sure that they know. So you don't file your taxes and then decide you want to make a prior year contribution, So again, if you want to win the game, you got to know the rules. And that's one of the rules, but it's just phenomenal for solo K investors. You don't have the December crunch anymore. Yay. So we talked about two parts, the employer, the plan, and the participant. So this is great. Now, we've talked about disallowed people, and they're still disallowed, but if a husband and wife own the sponsoring company, because understand, one of your companies, maybe you just have one, but maybe you have many, so one of your companies is going to sponsor the plan, okay? They're the sponsor. But maybe husband and wife are both, co-CEOs of that company. There's a plan, they can both be participants in the same plan. And assuming you have a really great year, what is that, $114,000 for a married couple, you could stick away tax deferred. That's really cool. Another little trick about the solo K. Another one is, plan participant. The participant portion doesn't have to be pre-tax. It can be Roth. And this is, like a mind blower, maybe you already know. But if you have a regular Roth, you've got contribution limits of up to $7,000. And if you make too much money, you can't even do that. There's something called the backdoor Roth, but that's another topic for another time. But you've got this major limit. If you make too much, you can't even contribute to a regular Roth IRA. But with the solo K Roth bucket, regardless of your income, you can put that big stack of money, that $19,000 or $26,000 per year in there. So that's a huge benefit of the solo 401k. Another one that you're mentioning, Sarah, is how with the solo 401k, if you're acquiring property, you don't pay the UDFI tax for that you would normally pay, unrelated debt financed income tax, UDFI. You can read about it on the IRS's website at irs.gov, publication 598. All right. And so there you go. But you do pay UBIT, unrelated business income tax, if your solo 401k invests in an active business. Again, tax advice range, so get tax advice. All right, I've said that. So there, any other solo 401k questions? I covered a lot of ground there.
Yeah, let me scan through it. I might have been broad enough to answer. So let me, how do, okay, if you have a 2 single member LLCs, do you have to set up a solo K for each, or can you set one up and contribute from any LLC you own?
Okay, so what you would do is one company would be the sponsoring company.
Okay.
You know, and so again, tax legal advice, I'm on the border, but yeah, one company, you would choose a company to be the sponsoring company. And again, you probably have a lot of companies, a lot of entrepreneurs do. So just pick one, and maybe it's your most profitable company, probably. But as long as you don't have any full-time employees, that's the one. Okay.
Okay, cool. And I think the other solo Ks questions were answered. Oh wait, if I fund a new, this is from Dave. Hi, Dave. If I fund a new self-directed 401k with this year's income, can I roll other qualified plan money into it after at a later date?
Yes, you can. And that's a nice thing, whether it's IRA or 401k, you can always transfer, roll over. You're not penalized, you're not limited on how many rollovers or transfers you can do, direct rollovers and transfers. But what you are limited to is you take personal possession of the money, you can only do that once within a 12-month period for IRAs. So know that, but rollovers and transfers are not limited. So yes, you can just build that account through contributions and take other accounts and put them all in the same one. Yes, you can absolutely do that. And it's not taxable. The rollover or the transfer isn't taxable as long as it's, you know, custodian to custodian.
Dave says, yay. Okay. A question, what's the difference between UBIT and UDFI?
UDFI.
Yeah, I think they just put an extra I in there. So self-directed IRA pays both, solo 401k pays only one of them?
Pretty much. Again, tax advice. So they're like twin taxes. Again, if you want to really know about it, go to irs.gov, look up publication 598, talk to Karla, talk to your tax advisor. But the difference is UBIT, unrelated business income tax, is tax when your IRA or 401k owns or is invested in an active business. Let me give you an illustration that makes it like really you could put it in your mind a little bit better. It kind of started with the Catholic Church, right? Like so many things have.
Oh goodness.
We're not bashing anybody, just saying. So if you're a tax protected entity like a church and you decide you're going to open a bakery, and that bakery is going to serve the community and you're going to sell your baked goods, but you're a church and you're tax exempt, so you don't pay tax, right? Well, here's Joe across the street and he's got a bakery. Well, he doesn't get this tax exemption and it's not fair. So unrelated business income tax doesn't just exist in the IRA world. It has to do with tax exempt entities. So the UBIT brings it even so that the tax deferred or the tax favored entity comes up to Joe's level and they're on the same playing field tax wise, you see. So unrelated business income tax. UDFI is a little bit different. And so what that is, say you buy, your IRA buys a house. I mean, and there are so many opportunities and there always are opportunities. So you find a house, say it's $100,000 for easy math. And so you took $70,000 from your IRA and you borrowed $30,000 from a non-recourse lender. It must be non-recourse lender. I'll emphasize that, non-recourse lender. And if you want, you can email me. I will give you a list of non-recourse lenders so that you are sure to do it right. So you've got this $100,000 house, 70% IRA money, 30% non-recourse money. Here comes your first rent check, right? So it's $1,000. Well, $700 of that your IRA earned because you saved. The other $300 your IRA earned because of debt. So unrelated debt financed income tax. The income is from debt financing. So it's that $300 that's subject to that tax. And you can take deductions and your tax person will help you and there you go. So that's kind of the difference between UBIT and UDFI. Hopefully that helps.
Okay, beautiful. Thank you.
Yeah.
Then I think we had one more, and then we'll bring all the speakers on to a larger Q&A. So let me look through, because you got a lot of questions, but I think a lot of them were very similar. So I'm just trying to read through quickly. Bill White. Okay, this one we didn't answer yet. If you are a custodian of an LLC located outside of California and not doing business, oh, sorry, that was more for Karla. That was maybe not for you. Okay. So I think we answered all the self-directed solo K kind of questions.
All right.
So what I'd like to do. Okay, cool. So what I'd like to do now is invite all the speakers to turn their video back on who are here. And so for you guys in the audience, please type away, ask your questions. We're bringing Chris Kirkpatrick is coming back. So if you joined a little bit later, I saw some people joining after Chris spoke. He helps entrepreneurs build their companies and then also plan their life, the finances in their life to match a lifestyle. We have Anton from Peak Financing. He talked about what's going on in the real estate markets and commercial real estate. Let's see. And it looks like Karla had to jump off and the other speakers had to jump off. So this is who we have. So audience, go ahead and type away, ask any questions that you want. Any questions for me about real estate syndications? We'd love to hear them. And while we're here, I'm going to pop over now. I've been living inside Zoom, so I'm going to pop over to the YouTube channel and take a look. All right. Go ahead, audience. Those who are still on, go ahead and type any questions that you might have for Chris, Anton, or Kaaren into the chat. And we're all here available to chat with you about them. Kaaren, I see some more questions about moving IRAs. And if there's one, if you have to open an IRA first and then move it into a self-directed IRA, or can you just open a self-directed IRA?
You can just open a self-directed IRA because again, an IRA is an IRA account. What makes it self-directed is the asset that you put into it or the asset that the custodian will allow you to put into it. And so yes, just go ahead and open a self-directed IRA. You don't have to open a typical IRA first.
Okay. All right. Then, okay, so Bill said actually his question was for you. So let me find his question again. Okay, so let's see. So Kaaren, Bill says this is for you. If you are a custodian of an LLC located outside of California and not doing business in California, will that LLC be required to pay California franchise tax because you are located in California?
I know the answer to this. I'm not an attorney, but I do know the answer. So if you wouldn't be a custodian of an LLC, if there are different kinds of LLCs, but it's my understanding that from the attorneys I know, that if you live in California and you're making the decisions in California, that yes, you'll still have to pay the franchise tax board your $800 fee. That is my understanding. But again, talk to your advisor.
Ask a tax person.
Yeah.
Cool, thank you for that.
Lawyer.
All right, then I see a question. I missed Sarah's info on what Sarah's syndication does. Okay, so I will try to boil it down into a couple sentences. What I do is I buy an apartment building, 100+ unit apartment building. It might be $5-10 million. It's a big purchase. So I don't have all the money for it. So me and my partners, we put it in an LLC. And we sell shares of that LLC to individual investors like yourself. And we use for the down payment, we get the down payment from individual investors. And then the rest of the money we get from someone like Anton, who's going to give us a big fat commercial non-recourse loan in order to buy the apartment building. And so that's how we put the funds together. We get a big commercial loan. We get the down payment from individual investors. We put it in an LLC. We run it as a company. We don't run it as a fund where we have all different properties together and mixing funds. We keep the funds completely separate for each building, separate investors. And again, it's an LLC. So you'd be a limited partner in that LLC. So you wouldn't be responsible at all for the loan. You wouldn't be responsible for any of the management. You would only be responsible for cashing the check that you get from us and, staying up to date on what's going on with your investment. But that's how it runs. And so there's two types of returns that you get from the type of assets that we invest in. We invest in cash flowing apartment buildings. So you would get either a monthly or quarterly check. And so each project is different, but what we're seeing right now is between 7 and 8% returns for our investors as far as cash flow. And then we do some sort of forced value add program where we're doing a remodel, a repositioning. And so when we sell it, we're selling it for a much higher price. And we give investors a return at the sale as well. So there's going to be forced appreciation on that property. Again, we do all the work, you do none of the work. And then when we sell it, you get a check at the end, and that's how it works. And so Alan, I see a question. What's the best way to talk to you about investing in your deals? Anna, if you wouldn't mind popping in the link to book a call with me. All of you guys are welcome to book a chat with me, and I can tell you about, we have 3 projects that are coming up between now and the end of the year. So lots of good stuff. There's a lot of opportunity right now. So go ahead and, you guys are all on my list now, so you'll get an invitation when one comes up. But also if you want to talk privately about what's the, nuances of the deal and how it works, please go ahead and book a chat with me. All right, there's a question from Marjorie. Hi, if I'm a nurse traveler, how can I manage my taxes? So that would be, we don't have Karla on. If Karla was here, I would have her answer that one for you. So Marjorie, I don't think anyone who's still on right now would be qualified to answer that for you. Here's a question from Dave for Kaaren. Oops, I scrolled and I lost the chat. If we already have a self-directed IRA at another organization, is there any benefit to rolling it over to UDirect?
There could be. We could, give us a call and we could discuss it. Our website is udirectira.com. You can find all our contact information. But I think one of the benefits might be our fees. Our fees are really low. We have our annual fee is a flat fee of $275 per year. If you're paying a lot more than that, that could be beneficial to move it over. And you have to ask yourself, are you happy with the service where you're at? If the answer is no, that could be a reason to start looking elsewhere. With us, we assign you to a particular transaction coordinator, so you're always working with that same person. So there's accountability, and then you get to know somebody, you kind of have a friendly, relationship with them. And that just can really smooth over transactions when you're always talking to the same person. Have you ever done that, been in a deal, and then had to go explain the thing from the beginning to a new person? That's pretty frustrating.
Yeah, and I would also say, the speed of their ability to execute for you is extremely important. So every time we have an offering, somebody misses out because their custodian didn't act soon enough, and we're overfunded, deals closed. And so if that's ever happened to you, then that's an opportunity to look for a company that can move faster.
And we do. It's usually 24, 48 hours. Yeah.
Yeah. And I don't know, I'm not joking. This is a really big deal. It happens over and over, and we hold places for people. In the past, I've said, okay, I'll take it on good faith that everything's going to happen in a timely manner, and we hold places, but then sometimes the deal closes and we're still waiting on the funds from that one person, from that one self-directed IRA company. And so that's why I look forward to talking to people like Kaaren and bringing them to you guys, because companies that can move fast for you, they're gonna allow you to take advantage of those great deals when you see them and not be the one left behind. All right, Chris, this one is for you. Chris, this is from Joe. He says, can you speak more about forbearance of one's mortgage?
Sure. Yeah, that's fun. So actually in one, well, this actually came up because a lot of people that I coach, entrepreneurs, they lost their income streams. And so when in my talk, I don't know if people missed it, but one of the biggest things with the forbearance is it's literally done on the honor system, basically saying if you, and I actually in the YouTube video link that they shared, that I saw you guys share, there's a link in there that actually goes to the CARES Act, and it's in it, and I have all the copy and paste right out of that in the description of the YouTube video that explains kind of how this works, and it's really done on the honor system. You get up to 12 months. You can, if you haven't done it yet, a lot of people are kind of feeling that it's too late. You know, like we've already experienced kind of the ugliness of COVID and the coronavirus. And the reality is, according to the CARES Act, you have up to 120 days after the end of the pandemic. And as of this moment right now, the pandemic is still going. And so you still, like, from the time this video is recorded right now, you have 120 days at least, because if tomorrow, you know, whatever, they call it an end, which we all
That
know
would be
is not
amazing.
right? Wouldn't that be cool? But so
Make it happen, Chris. Make it happen.
yeah, right. So all you have to do though is literally all you have to do is, there's a couple of pitfalls you want to make sure that you avoid though. Like when you call your mortgage company, there have been a lot of instances with some of the bigger mortgage companies where they are getting people to restructure their loans, you know, do different loan modification programs, so on and so forth. You need to be very adamant and tell them that, no, I'm not looking to do a modification, because if you do that, you're done. Like, you get stuck. And so you want to make sure that you say no, according to, and that's why I say read the comments of my YouTube video, follow that link, and really, I think it's section like 4402 or something like that. Like, but it's all in my YouTube link in the CARES Act, and go in and just read that. It's literally like a page long that's just dedicated to this. And you can do it up to 6 months at a time. I'm kind of coaching my clients to do it 3 months at a time. But at the end of every stage, all you have to do is call them and say, hey, listen, times are still tough. Kick the can down the road for me. And the great part about that is you can literally just pop that on to the end of your mortgage. So it'll extend your mortgage a year, or, and this is the kick, and you have to make sure you're aware of this. If you sell your house, you're going to be responsible to catch up upon sale of house, right? So upon the sale of the property. So you're going to have to deal with that. And so like Karen's been saying, like, there's obviously tax stuff, like make sure you talk to your accountant and figure out how it works with you and all that stuff. But philosophically, this is my mindset on, I'm kind of a believer. If you have debt, I'm a huge believer that nobody knows where the world's going right now. There's never been more uncertainty than there is right now. And so we're all dealing with financial hardship. Every single person on the face of this earth is dealing with financial hardship because of the fact that there's uncertainty. So as an entrepreneur, if you have the ability, if you have other debt, which we all do, no other debt that you have is as healthy as your mortgage debt, period. So I would rather take the cash flow from that, kick it down the road, take that cash, either invest it in something, or to create more cash flow to help with my debt down the road, or take that and pay off other more toxic debt, you know, if you may have it, and just make sure that your financial standing is in much better position. That's kind of my philosophy on the mortgage forbearance thing. So, but it really is as simple as calling your financial institution and telling them, hey, listen, times suck right now. Like, let me do this. They're going to send you a piece of paper. It's not an application. It's literally just, hey, sign this and you're good. Like, and if it's more complicated than that, then there's something to be worried about.
All right, cool. So this is from MacArthur. It's kind of similar to that one, Chris. Do you have any advice about extending a forbearance on a personal property at the end of the initial 6-month forbearance where the mortgage is not with Fannie or Freddie?
So it's not a federally guaranteed loan. So no, that gets a little more complicated. There's not as many protections. So the CARES Act is designed to protect those loans that are backed by Fannie and Freddie, which are basically federally backed institutions. But I mean, it's really rare. I mean, if you have one of those, it's a rare scenario. I mean, it's literally like less than like 5% of the loans out there. So the answer is I don't know what to tell you about that.
Okay, cool. Thank you.
I'll look it up though. Now I'm curious.
All right, next one is from Amy, and this one can be for everyone. Comment on how you think, it's kind of written weird, sorry, Amy. Comments about diversification within your real estate portfolio. What type of assets, what markets? So I'll start this one. So I think, I mean, I'm I'm not very good at diversification. Me, myself, I'm like all in on two types. I'm in hotel development and multifamily. And I think it's good to get a little more diversification in there. However, I know multifamily so well, so I know when it's a screaming deal, and I don't know commercial or retail as well in order to know if it's a screaming good deal. So I think diversification is really good if you have an equal level of knowledge across different asset types. If you have no knowledge of a certain asset type, I wouldn't say, well, I need to, just for the sake of diversification, I'm going to invest in it. I think you should diversify across what you know. And if you want to do more diversification, learn enough about it before you get into it. But I do think diversification is good. I'll let someone else answer that as well.
Dare I speak? Anton, go ahead. I saw him on mute. I'll let him go.
Yeah. So I would say you probably have to make a distinction from a GP or a deal sponsor compared to a passive investor, right? For a passive investor, I think it's worthwhile to diversify and invest in other commercial real estate assets other than multifamily, as long as you pick the right GPs that really have that deep experience in that segment, right? And that is, I would say, is one of the biggest problems, that you have some GPs that have been very good in multifamily or in some other asset class, and now they decide, well, I see that the grass is greener on the other side, now I'm doing this, yet they do not have any experience in that. So just because someone is really experienced in multifamily doesn't mean that they are equally good in, let's say, self-storage, which has been kind of one of the more popular asset classes that multifamily sponsors have picked recently. And some of them I know have already been burned, right? Because they do not really understand the market dynamics of self-storage and how the barriers of entries work in that type of segment. So as long as you invest with someone who's really understanding that particular asset class, I think it's okay. As a deal sponsor, I would say, if, let's say, you, Sarah, decide, look, I want to diversify, I would say that's fine, but I would try it on your own with your own money, or close friends and family money that is more kind of joint venture money, to prove your case. And once you see that your ideas actually work, then it's time to invite passive investors. Right?
Mm-hmm.
Mm-hmm.
Yes, agree. Kaaren, what do you think about this one?
Yeah, I don't give investment advice.
Oh, okay, okay.
Well, I can talk about some of the asset classes you can put in a self-directed IRA, though. Just in general, there's, precious metals. They're kind of hot right now. There's debt, so your IRA can be the bank and lend money. You can buy performing and non-performing debt and hopefully get it reperforming, and and use that as income stream for your self-directed IRA. Of course, real estate in all its forms, and private placements, private equity, these secured, these SEC promulgated kind of assets. Those are really the number one asset class for self-directed IRA. So all those different sorts of vehicles is what you can put into a self-directed IRA.
Very cool. Thank you. Chris, you have an opinion on this one?
Too big of one. But I would say what I find is people like the whole concept of diversification. To me, I would say diversification is great as long as you understand, like, you're diversifying in assets that are not correlated in movement. Like, I think too many people think they're diversified and they're not. And then the other thing, or they're not as diversified as they think they are. And then the other thing is, I think to the audience that's here, I think it's really important to say, don't diversify too early. Like that's one of the things that I see people do, is they diversify like so much right out of the gate. Like, if you're running a business or if you're trying to build your real estate portfolio, like, trying to diversify can make it so you're in all these different areas, and it can make it so it takes you longer to get into that real estate deal, for instance, that's going to be the investment that's going to catapult you forward and get the results that you want, and help you create that initial flow of wealth that helps you kind of create that critical mass that then gets you to the level where now you can say, okay, I have this chunk of money, let's diversify. Warren Buffett didn't start owning hundreds of companies. He started by owning one, and then it built out from there. And it just, it's timing.
Yes, love it. Okay, thank you for that. The next one is for Kaaren. Can you roll over just a portion of an IRA or old 401k, not with your current employer, into a self-directed IRA, or must you roll over the entire account amount?
Yeah, great question. Complete or partial transfer, right? So with a 401k or an employer plan, it really depends upon the plan administrator again. So they may say, we will only disperse everything. So they may not give you the option of doing a partial rollover. You have to ask them. We'll accept a partial rollover if they'll do it. With an IRA, it's always a choice of complete or partial. But I'll tell you where the one place where people get stuck is they are going to do, say, a $50,000 investment, maybe like a private placement or a note or something. So they only transfer over $50,000, but they're forgetting the $15 wire fee. They're forgetting their annual fee. And so you always put a little pad in there so that you have enough and you don't come up short when it's really, time to pull the trigger and fund the deal.
Awesome, thank you for that. Off-topic question for the panelists. This is from Dave. In today's very low interest rate environment, do you have any recommendations for where to put your emergency savings funds? Better options than 0% MMFs?
Well, try to find one that pays more than 0%. Right? I mean, there are certainly plenty of online banks out there that offer 0.5, 0.6% savings accounts. So it's, I would say it's extremely easy to park today if you just have funds that you want to be completely liquid, but you don't want to keep with your usual bank where they may pay 0.5 or 0%. And you can transfer in and out from these banks very quickly. They're still FDIC insured. So I would say that's probably, from my perspective, if you really want to stay truly liquid, that's the best option.
Awesome. Another one for you, Anton. Do you work with CRE investment firms trying to pick up distressed CREs in auction?
Yes, we do. However, there is a caveat there, right? For auction purchases are very tricky to do, right? Because I don't know whether any one of you have bought at auction, whether it's at the local auction at the courthouse, which are kind of the mostly obviously smaller properties, a lot of single family homes. Sometimes they have office buildings or multifamily, but typically not. When we talk, I assume that individual talks about these larger online auctions that are now have come up. They are certainly a good source to find potential deals. The problem is that you have to you have to do all your due diligence up front. You do not know whether you win that deal, right? So turning it around like what you do, Sarah, in most instances, you do your initial due diligence, you may tour a property, and then you submit your LOI, but the majority of your due diligence is after you have an accepted LOI and then a PSA. Whereas with an auction, you essentially either buy it blind, so the purchase price has to be so low that you can take the risk of buying it blind, or you spend a massive amount of due diligence money up front without ever knowing whether you win that bid, right? So that is a general comment about how difficult it is, in my view, to pick up good quality assets at auction. The best way from my perspective is also because lenders are not really that eager to give you truly accurate quotes on these auction purchases, because they just do not know who ultimately will be the buyer. So they've come up with a general quote that is typically applicable to the best possible sponsor that will buy that property, right? So that may not be applicable to you as a buyer, but more for the best possible buyer for that deal. and assuming that all the unknown elements are what the lender is anticipating. So in my view, to truly pick up true deals at auction, the best way to really do it is to come in with a significant amount of money, ideally full cash, or at least have the ability to pay full cash and then refinance after that. Because all the big players do that, right? So they come in with all the resources. They can pay cash if necessary. They will still try to do a loan on them if the deal supports a particular amount of loan. But if the deal, after they win the auction, if they decide, well, now it's only 50%, we originally hoped that we can get 70%, they still can close, but they are not depending nearly as much on the debt financing as for a traditional acquisition.
Yeah, beautiful. Thank you for that, Anton. I've tried to buy single family homes at auction, but I haven't tried something large commercial. Okay, let's see. Here's another one for Kaaren. IRA money placed at UDirect IRA, is it making any interest while waiting to move to an investment? I think what Karen's going to answer is true for all IRA companies.
It is. It's kind of, well, I mean, a lot of IRAs, companies give you nothing. We do give you 0.1%. So it's a teeny something.
Okay.
So there's that.
All right, cool. All right, Mark, another question. Any comments on buying notes? So I am not a note expert. Anybody want to take this one?
Well, I'm not a note expert. I personally have bought some notes, but I'm definitely not a note expert. I would say there's only a very big distinction between buying notes for kind of private loans that are out there that are then traded among private individuals, and I think that's quite an active market out there. But I have no idea of how well the general performance there is. As you move up into commercial properties, if you want to buy a note from a bank or a larger lender, when you start out, I would say reach out to your local community bank or credit union and talk to them about potential notes that they want to sell. You have to start out small there, because the larger loans and then also the larger lenders, they already have a very established pool of prospective buyers. So you really have to start out small there.
Cool, thank you for that. Then we have one from Judy. Can we invest with a spouse? So Judy, if you're talking about investing with me, yep, all the time. So someone might say I'm the primary, but then they're investing jointly with their spouse. So both people are on all the paperwork. So definitely a common way to do it.
I could, oh,
yeah,
I'm
go
sorry.
ahead.
Sorry to interrupt you. Well, if she's talking about IRAs, I'll address that when you're done.
Okay, yeah, go ahead.
So, so I was just going to say, with an IRA, that's a big deal. So we were talking about spouses are disallowed to your IRA, and I get this question a lot. So I figured maybe she meant IRA. But so normally you can't invest with a spouse, but it's an exception where as long as you invest concurrently, you can do it, and it's not a disallowed thing. So what you just don't do is invest in an asset that your spouse already owns. So with a self-directed IRA, you and your spouse can invest together as long as you do so concurrently.
Cool, thank you. Oh, I see. The rest of Judy's question was completed in a different sentence. She said, can we invest with spouse, both do 50% in an investment within an LLC or joint venture?
Oh,
okay. Okay, there we go. There was just someone's comments in between.
Got it.
So yeah, Judy, if you have an LLC, my husband and I have a holding company, and we're 50-50 owners, and we use that to hold all of our passive investments. And so when we invest, it's the EIN for the LLC is what invests. And so it's not, the investment's not in my name, it's not in my husband's name. You can have that holding company own your passive income assets. So yes, and you can do any percent that you want. Let's see. Mark Littleton, best advice for 2 rental properties that have no mortgages. So wow, this is great. I think you have such a great asset. So there are so many things that so lots of times what I do when I have a meeting with an investor is I'll go through the numbers, because you have a lot of opportunities if you have 2 assets that have no debt on them. You have an opportunity to take a look at how that's performing. So a lot of times people will say, well, I bought it for 100 and now it's worth 200. But I have this mortgage and it's kind of a more complicated math problem. But if you have no mortgage, I would encourage you to look at the ROI that you're receiving. So if it's worth $100,000 and the yearly rent that you're getting is, $20,000 per year is your net returns, 20% annualized return, then that's great. If you do the math and your annualized return is around 2%, which, believe me, I've done this. I've sat with hundreds of investors and we do the ROI on their real estate investment and they don't realize that they're getting 2, 3, and 4% return on investment on their rental properties, and they're doing all the work themselves. And so I'm not saying if you're in that boat that you should sell your property, but you should definitely take a good hard look at what is the ROI on those 2 rental properties, and also look at what you could be doing with that money. So again, if you may have bought it for 20, but it's now worth 100. So don't do the ROI on 20,000. Do the ROA on 100,000, because that's actually the value of your asset. So if you sold it today, you would have 100 that you could invest in something else. So I'd love it, actually, Mark, if you find my link in the chat. I'd love to sit down and work through the numbers with you. That's one of my most favorite things to do, is looking at properties that you have, the different ROIs, and the debt. And lots of people will also maybe say, well, I'd like to keep those, but take out a line of credit on those rental properties and use that to invest in a syndication. And that's also powerful and can create a situation where you essentially have a higher ROI on that. Does anyone else want to comment on that topic? No? Okay, cool. Oh, okay, I think this one's for you, Chris. So I'm 28 years old and I have a family, a husband and a 3-year-old. Why should we consider getting life insurance? Thank you.
Oh boy. So I could do an hour on this alone. So there's a couple things to think about. Not all life insurance is created equally. So when somebody says, why should I consider getting life insurance? My first question is like, what kind of life insurance are you considering getting, first of all? Secondly, it really comes down to, I always tell people life insurance isn't a need product, it's a want product. And I think that's one of the big reasons that the insurance industry, I left it, because it kind of drives me nuts that most agents, they look at it and they try to sell it based on need. So they say, you make $100,000 and you got to have enough insurance to be 20 years of your income. And, I'm a big believer in asking why, right? Like, why is that the case? Why do people believe that? And so to me, there should be no calculators out there that tell you, okay, I make this much money and here's how much I need. The question really is, what do you want to happen? And so I always kind of tell people life insurance is the only financial tool in the world that will make what you want to happen when you want it to happen, whether you're here to see it or not. And the question is just, what do you want your life to look like? And so my big attraction to life insurance, and why I do this for my own family, why I coach every entrepreneur that I work with to use a kind of a banking alternative structure policy in place for them, is simply because it gives you the liquidity, use, and control of your money. It after a couple of years, yeah, there's some expenses on the front end, but if you buy into a long-term strategy, you're within 3 years, you're going to be getting more out of the policy than you're putting into it. the first 2 years, you lose a little liquidity of the money, but once again, you buy into the long-term strategy. And then it's a lot of leverage. Like we talked about earlier, I bought my trailer using my policy. I'm going to be able to leverage that. We buy real estate, cash flow real estate in Atlanta with our policy. All these different things. And I mean, I've done, once again, go to my YouTube channel, and I've done so many videos on this because I don't want to take everybody's time. Like, I literally could talk about this for hours. What I will say is, you just really have to start with the end in mind, figure out what you want. And I promise you, to me, I'm a big believer people invest too quickly and they don't save enough. And as Americans, we're programmed that we need to save, and people kind of misappropriate the term saving into investing. And the problem is, when you invest before you save, you're taking on risk before you're ready. And then, and this is what my whole financial pyramid talk is about that I do on YouTube is you need to make sure that you have the financial foundation built in your life. That way, if you do get into the wrong investment, or if the market does go down, or if there is a downtick at any point in time, you're prepared to handle that, right? Like, so you don't have to liquidate a negatively performing asset. So you don't have to make bad financial decisions. And so I think for me, I think when you do it the right way, a life insurance policy is, you need to make sure, okay, when I'm not here, is what I want to happen for my family, for my child, for my spouse, is that covered, right? So if cash flow is tight, you get term, right? You just get term insurance because it covers it, and that's fine. But if you're somebody who's looking to kind of create something bigger, that's where the conversation about like a properly structured whole life insurance policy comes in, to be able to kind of be that foundation of your life. And I mean, Kaaren, I'd be interested in talking to you about this because I've never gone down this road, but I've always kind of wondered, could I get creative enough to structure a policy for somebody? And I don't sell these anymore, by the way. I used to. I'm just really passionate about using whole life as an entrepreneur because of all the leverage it gives you. But what I've always been curious is, can you take a whole life policy? And well, I know I can because I've actually used it as a hard money lender before. But when you talk about using debt instruments inside of a solo 401k, could I use my whole life policy inside of a self-directed IRA and then lend it out and get a return on that? I don't know. Maybe
the IRS already beat you to that one, and the answer is no. There are only two things you can't put into an IRA. It's life insurance contracts and collectibles. So that would be, sorry, but brilliant idea.
I know, it's because the tax benefits are already too good to what they have. So like, they're not going to let you double dip. So I get it. It makes sense. But the bottom line is I think when you do it properly, so I'm going to tag this back to the person who asked, where's an alternative to put money in a bank account that will get a better return. I'm telling you what, every dollar I get, my savings account, I use my whole life policy as a liquid account for my savings vehicle as my protection, because I have liquidity within 72 hours. So it's not a checking account, but it is a safety account, right? And I use it for opportunity. I mentioned the market's cyclical, it's not linear. And so when I'm happy making that 4 to 6% and then keeping that money in there like a bank account, earning 4 to 6%. And then when I find the opportunity in real estate, in business, in something else, then I can take a loan against that policy and get that asset, right? And that's where it's powerful. So it kind of can, if you structure it properly, it kills two birds with one stone.
Very cool. Thank you for that, Chris. Karina was expanding. She said, I was thinking for a college education for my son.
Yeah, so absolutely. All right. So when I was in the financial industry, I was a certified college planning expert. And so I actually have how to save on college, not just save for college. I have a webinar from like 5 years ago on my YouTube channel. So some of the tax stuff may be a little outdated or whatever, but you can go to my YouTube channel and find that webinar. Here's the thing. Here's the beautiful part about when you use a whole life insurance policy. So all these other assets, whatever it is, whether it's a 401k, whether it's or an IRA, because I think 401ks are actually excluded, but an IRA, whether it's so many other accounts. Like I'm not going to go one by one, but they're all counted against your expected family contribution, right? Your EFC. And so when you go to apply as far as trying to get tuition assistance, trying to get grants, trying to get loans, before you qualify for anything, you're going to have what's called an EFC, expected family contribution. And the ugly part about that is if you make too much money or you have too much in savings in the wrong accounts, they're going to expect you to liquidate before they give you anything. And what they don't tell you is that when somebody says Duke University costs $65,000 a year, which is completely insane, what they don't tell you is that even though that's the case, that's not what people are typically paying. There's a sticker price, which is the $65,000 advertised, and then there's the real price that most people are paying. And so if you have your assets in a place that makes it look like, and this is great, like, and you want to talk to the right tax person for this, because if they have a 2-year look back period when you're doing college, so you want to make sure if you can reduce your income during those 2 years as your kids are going in. And if you put your money in a whole life policy, it is one of the best assets in the world that does not even get looked at in most cases. There are a couple private schools that actually take it into consideration, but for any public university, it is not looked at to go against your expected family contribution. So it's, if you put your money in a 529 account, they're going to expect you to liquidate that on a systematic basis based on how many kids you have and so on and so forth before you even qualify for anything. So if you're going to spend $200,000 on your kid's education and you have $200,000 in a 529, I know everybody says to do that, but like you just kind of screwed yourself. You're now paying $200,000 for college and you didn't need to.
Awesome. Thank you, Chris. The comments are saying, just went through this, still learning. So many good stuff. Thank you. Those are the comments you got. Cool. Awesome. Well, audience, if you have any final questions, go ahead and put them in. And while you are doing that, audience, I will thank Kaaren, Anton, and Chris for staying extra and helping answer all these questions. So audience, those of you who are still on, super proud of you. Like, how many hours has it been now? It's like going into the 5th hour. You guys are committed. You're committed to learning. You're committed to taking action. You're committed to making this a priority. Very, very proud of you. I encourage you to reach out to everyone. And like I've been saying, it's an ecosystem. So I can help you place your money in an investment. Kaaren can help you do things. Everyone can help you do things. So take advantage of the resources available to you. I will be emailing out afterwards. We put links in the chat. If you joined late, you can go back up through the chat and find the links. Also, if you joined late, you can scroll back through the YouTube live and you can still watch it from the beginning. You can watch the part that you missed. And then afterwards, I have all your emails. I'll be sending you all the links to make sure you can get in touch with our speakers. Many of them had free gifts to offer. And so we're gonna make sure you get links to their free gifts. And Anton, there was a question for you. Someone said, what's the best way to get in touch with Anton?
Oh, I put it in the chat.
Okay.
My email address is anton@peakfinancing.com. So that's probably the easiest. Yeah.
All right, cool, beautiful. So some people are asking for repeats, yada, yada. Just scroll, like there's a little red bar at the bottom of the YouTube live. Just scroll all the way to the beginning and hit play there. And then you can watch any of the beginning part that you missed, which was me. So please go back to the beginning and hit play there and you can watch it from the beginning. Jerry, hi, Jerry. Saying, I hope you have some new projects coming down the pipeline. I do, Jerry. So we've already done, we're like final stages of negotiating on a large complex in Columbia, South Carolina again. So same team, same market, same return schedule as what you've seen before. And really it's like final stages. We keep thinking it's going to be any day now. We did some of the due diligence already. It's looking good. So definitely ears open, get ready. Thank you for that. So Rhoda, yes, if you came late, I was saying just scroll backwards. You can rewatch from the beginning, just that little red bar on the YouTube live, just scroll back to the beginning. And you're welcome, you're welcome. I see lots of thank yous. You're very welcome, everyone. And thank you to all the speakers for staying on this long. Chris, there just popped up like 5 more questions for you. So I can run through those. And of course, Kaaren and Anton, if you guys want to stay on, welcome to. Okay, let's see.
Thank you so much, Sarah.
Yeah, you're welcome.
You're out of here?
Really appreciate it.
Kaaren, I'm going to call you.
Sounds great.
Awesome.
Okay, guys. Thank you.
Well, great. Thank you for your time, Kaaren, very much.
Okay.
Bye-bye.
Sarah, I just put a link in our chat in the Zoom for the presenters for that college planning video that you can share with people if they're interested in that. It's a 59-minute webinar that kind of coaches them through.
Oh, great.
Elements of that might be helpful.
Okay, yeah, there are a couple of questions on that, so perfect.
As far as that goes.
Anna or Jelena, if you can put that chat into the YouTube, that would be great.
Perfect.
Okay, Chris, do you use IUL or a regular cash value policy with a mutual company?
Oh, so I have, okay. So I'm not a believer in index universal life. So little backstory. So when I first got into the industry, I was a director. Well, I was an agent and I worked my way up over a couple-year period to become the director of business development for Fortune 1000 life insurance company. And what they did was they really focused on index universal life. They were one of the top 4 product manufacturers of index universal life in the country. And here's the deal. One of the things that really got me to the point where it started my wheels spinning and got me ultimately to leave the company was the fact that I talked to one of the key product designers of an index universal life, of the index universal life chassis at this company. And I said, okay, if whole life insurance is so good, you know, why did you create index universal life? Because it seems too good to be true to be able to have this product that can get you up to 13%, has your return on investment inside the policy capped, you know, at 13, but you can never lose. So the floor is 0. That's the whole sales pitch for them. Yet you somehow are able to pay agents a higher percentage of commission. You're somehow able to have more growth in the policy. And how are you able to accomplish this? You know, if you're paying more commissions out, giving better returns, it seems like we found the holy grail, right? Like, how is that possible? And he said, well, actually, that's not the case at all. Really, insurance companies created index universal life to basically take the risk of a whole life that life insurance companies have with whole life insurance and displace that risk back to the insured, right? Because what happens is, and they don't tell you this, is that index universal life policies, all the administrative fees, all the internal costs, those are not guaranteed and fixed. Those are subject to change on an annual basis. So yes, your return on investment is only as good as your return on investment after all fees, right? And administrative fees and internal costs and everything. I don't care what investment you're talking about. And so what I always tell people is, if you're looking at a life insurance policy to be your vehicle for investment, you're looking at it completely wrong. And the only people that look at index universal life as an investment, they're the people that sell that are the salespeople. And they do that because an independent agent, and I'm just being totally transparent here, and because I've got an anchoring for the financial industry about this, the life insurance industry about this, is that the reason index universal life has become so popular is because if you're an independent agent and you want to sell life insurance, which obviously there are tens of thousands of people out there that do it, you can get paid 140% commission on the base premium for an IUL policy. You're probably, that same producing agent is only going to get about 80 to 90% on a whole life policy. So that's a significant bump, you know, in doing that. And that's why so many people are selling them. But what I would say to you is, in index universal life policy, you're taking on more risk as the insurance. Is there more upside in the policy? Sure, there is. But the upside in the policy, to me, is not worth it when you can just use the policy as a storage vehicle, as a banking alternative, But if you want to compare it to a banking alternative, it better darn well have the guarantees that a bank is going to give you, right? And when you go into an IUL, you lose those guarantees. And so that's why I have the philosophy that a whole life policy is best. If you are a real estate investor, if you are somebody who's an entrepreneur that wants to invest in your business or anything else of that nature, a whole life policy is definitely the best way to go, because your money is going to be safe and secure and guaranteed and liquid. And then when you find the opportunity in real estate, then you go all in, or you know, maybe partially in, but like, versus, you know, having your money in a vehicle where it could change on a year-to-year basis. And I've seen too many people have these policies blow up after 15 years because they get older and the internal costs go up year after year after year. And it's, if they're not performing really, really well, then it blows up on them. Now, the last 10 years have been fantastic because the market's done great and IULs have performed really well. But that's also, you know, kind of indicative that it might not be that way for the next 5 years or so.
Thank you for that, Chris. And I think something that's really, I mean, there are a lot of important things in there, but kind of the most important thing that I pulled away from that is understand people who are giving you advice, understand their incentive, understand how they're getting compensated. Totally. Because like you just said, and we talked about it earlier with a couple different speakers, is, you know, even if it's the most like moral person, your subconscious is so powerful. If you get paid a lot more to offer A over B, you're going to offer A. I mean, even if you're a really good person trying to do its best for the person. So really, yeah, exactly. Knowing how people are compensated is very important when looking for people who are going to be in your ecosystem.
And here's the bottom line behind that is, like, in the life insurance world specifically, I talk a lot on my YouTube channel about, and for entrepreneurs, about how to have a properly structured policy. And people are always like, what does that even mean? Well, we don't have time for all that here, and I have plenty of videos on it. But what I will say is that in order for an agent to sell anybody a properly structured policy, they're taking a 85 to 95% commission cut to do it the right way. So there's a reason that most people don't do it, is because they can't afford to do it. The industry is not designed to do it in mass, right? To do it in mass scale. And so I think it's kind of a moral hazard in the life insurance industry, honestly. But it's you know, it's something to think about and know. And if anybody has, I can't sell anybody anything. I cannot sell life insurance. I'm just super passionate about this. So if anybody has any questions, you can go to life180.com and I have a link. Set up an appointment with me. I'm happy to talk to you.
Yeah, beautiful. All right, so I'm seeing lots of thank yous. Rhoda, you're welcome. Dale, you're welcome. Marjorie, you're welcome. Kuniko, you're welcome. Cleet, hi Cleet, you're very welcome. Glad you are here. Tim, great to see you. You're welcome for putting this together. I hope you enjoyed all the speakers. And nice to see you. Thank you for the kind words. Glad you're enjoying the content. Thank you all for attending and staying so long. Awesome, amazing. Okay, so I think it's a nice time to wrap up. Again, Chris and Anton, thank you for staying on, answering all the questions. Everyone who's on, we'll send out contact links so you can get in touch with these guys for more info if you like.
Awesome.
Yeah, thanks for having me on. It was a pleasure.
Yes, you're welcome. All right, well, we'll call that a wrap. Thank you, everybody. Have a wonderful rest of your day, and you'll hear from me shortly with more information.
Rock and roll. Have a good one.
See ya.